All right, cool. So taxes on options. The first thing I'd have you think through is, let's say you buy a call. Okay, there are three potential outcomes with whenever you start with any option. What are like, and what do you think comes to mind with the three outcomes for options?
Well, like it expire worthless.
Good. Okay.
You could close it, trade it,
Good. Good.
or you could exercise it.
Perfect. So I want to put that here. So there are three outcomes for options, and each of them comes with their own kind of way of looking at how they're taxed, but it all revolves around these three different outcomes that you have for options, which is number one, just like you said, they could expire. They could expire. Number two, they could be traded, which is another way of saying closing transactions. Or three, it could exercise. And we'll go through them in that order. I think this is the best way to make your way through. I think we're gonna have a pretty easy time with one and two, and then three with the exercise part of it. That's where it gets a little tricky, but we'll make sure that you feel really good with it. Okay, so let's go through an example. Let's say we go long one ABC Jan 60 call. Let's say we go long at, I don't know, 7. Okay. And then a few months later, the option expires. Now, without even thinking about or too much about the tax consequence here, like what is if you buy an option and then it expires worthless, what does that feel like to you?
It was like I just lost $700.
Yeah, you just lost $700. That's exactly what I'm looking for. So when you buy an option and it expires into nothing, you are establishing a capital loss. Specifically, this would be a short-term capital loss. You'll have a short-term capital loss of $700, at least in this example here. Okay. And that when an option expires, you're either going to have a capital gain or a capital loss. 9 times out of 10, it's going to be a short-term version of it because you're dealing with options. And do you remember the longest maturity that you can have with an option?
Well, it's 9 months with just a regular option.
Good. And you're thinking back here at leaps, right? Like leaps could potentially be long-term. If we're talking a leap, that could be a long-term capital gain or capital loss, but you'd have to hold it obviously for more than a year. And let me say something else too. You can only see a long-term capital gain or capital loss with a long option. I don't know if that's something you've come across yet. Do you know what I'm talking about? Have you seen that before?
Kind of.
Whenever you go short anything, and that could be short stock or short an option, let's say that you go short a leap for 3 years, which is possible. You could go short for 3 years. That still will be a short-term capital gain or capital loss at the end of the game, at the end of the story there. And the IRS has this view that if you go short something, that you're not actually holding anything. Same thing applies to going short stock. You could short stock for 5 years and then close out the position, and then they would still consider it a short-term capital gain or capital loss because, again, the IRS just doesn't believe you're holding anything when you're going short. It's almost like you have a negative position in your account. So what I'm trying to say here is that, bottom line, if you are doing something short, and that could be going short an option or going short stock, either way, always going to be short-term. And it can never be long term. The only time you're going to see a long term capital gain or capital loss with a leap is with a leap that's been held for more than a year. Does that make sense what I'm saying there?
So the short option, when held for a year, a leap,
Mm-hmm.
is the only time that a short anything. And then
long. Does that make like if you go short a call, let's say you go short a leap call for 3 years, that will still be a short-term capital gain or capital loss.
Okay.
And it's just the IRS doesn't believe that they will never give a long-term anything to a short anything. if that makes sense. So like if I go short stock or if I go short an option, that will always be a short-term capital gain or capital loss if I end up with a capital gain or capital loss. The only time you can see a long-term capital gain or capital loss is if you hold an option, specifically a leap, if you buy an option and you hold it for more than 1 year.
Okay.
Okay.
That makes sense.
Okay. I
Especially
really don't think
in
it's to that
terms of
point.
short stock, because you're selling, you're borrowing it, and then you're selling it right away back into the market.
You're not
You're
really
not,
holding anything,
you're
right?
not holding it.
Yeah, at least that's the IRS's view. And yeah, you're right. So you could go short stock for 5 years again, and it'd still be a short-term capital gain or capital loss at the end because you didn't really hold anything. At least that's
Okay.
the thought process. So cool.
Makes sense.
That's that. So we're focusing on the expiration. Let me just put one more thing here for the expire, and we'll just do the exact opposite where you're going short. So let's say you go short 1 ABC Jan 30 put at 3. Okay, so you sell a put, the option expires. What does that sound like to you? Like what's the tax consequence here?
We took in $300, so we're gonna probably have a short-term capital gain of 300.
Short-term capital gain of $300. That's it. The expiration with taxes is a piece of cake. Whatever it's either a gain or a loss in terms of capital gain or capital loss in the amount of the premium every time. That's it. Nothing more complicated than that. Any questions about that before we move on to being traded?
No, that's easy.
Cool. So traded is also going to be a pretty similar situation too. So let's go there. So let's say that we traded the option, and I'll stick with the same examples here, except we'll have to get rid of the first part here. Let's say a few months later, the customer we do a closing transaction at I don't know, let's say 3. No, let's say 4. So we'll go long the 60 call at 7, and then the customer does a closing transaction at 4. And I can't remember if that's something that we've talked about. I don't think we have a lot, at least a lot. Yeah, like does that the idea of a closing transaction? You're right. $300 would be the tax consequence in one way or another. But when I say closing transaction, does that make sense? What I'm saying there?
Yeah, that just means that I'm trading it.
Yeah, you bought this
Or
call.
you're
Yeah.
gonna have to give me money for it.
Yeah. When you buy an option or sell an option, but when you're dealing with an option, you don't have to wait until it's exercised or until it expires. You can actually trade it to someone else, and that's what a closing transaction is. So if you bought this call and did a closing transaction before, that's just a fancy way of saying you sold this call to someone else. Now someone else holds the 60 call, it's just not you. So you bought at 7, you sold at 4. What does it sound like to you? Is that a capital gain or a capital loss?
Well, we paid 700, but we got 400, so it's a $300 loss.
Yeah, short-term capital loss of $300. That's it. Easy, right? So it takes an extra step there, an extra step to get to the right answer. It's not as easy as the expiration, but it's the same idea, right? And then let's go over here real quick. Let's just go short the other way, and let's say that instead of the option expiring, let's say that we do a closing. Now, here's a test question for you. The customer goes short the put, and they'll do a closing transaction to get rid of that. Now, would they do a closing purchase or a closing sale to close out that put?
We sold it, so we're gonna have to buy it back.
Good. So if we said closing purchase, if you sell an option up front, you got to buy it back. So we do a closing purchase. Let's say that we do it at 6. No, let's do 8, just to keep numbers different. But yeah, closing purchase at 8. What does that feel like to you?
All right, so we took in $3.
Mm-hmm.
But then we took in another $8. Short-term gain of 11.
Not 11. Think about what we're doing when we're closing. Are we buying or selling?
We're buying.
Mm-hmm. So I think we're gonna end up here with two. I probably should have set this up as a capital gain, just to be opposite on the other side here. But we sold at 3, we bought at 8. To me, that would be not a closing. That would be a short-term capital loss of $500. Does that make sense? What I did there?
Because we bought it back
Mm-hmm.
for 8.
Mm-hmm.
We
Keyword that
paid
being.
we paid 8 into the market.
Mm-hmm.
Okay, yeah, that makes sense.
Yeah. Keyword there being purchase. So
We're
yeah, that's it.
this is the only, we just don't want the obligation anymore. So
Yeah. Yep.
that's the only way out of it.
Exactly. The only thing I just went over here and I just updated this from closing transaction to be specific to a closing sale. So right, like when we buy the call, we would have done a closing sale at 4. But closing sale being that we bought it up front, so we'd be selling it on the back end. Let me give you one other example just to make sure we feel really good about this part. But let's say that we go, say we go short one ABC Jan 40 call at 5. And then we do a closing. Now, let me ask you, okay? So we go shut that call. What are we doing to close out that call? Are we doing a closing purchase or a closing sale?
It's a sale.
Got it.
Hold on.
Mm-hmm.
It's a purchase because it's a short.
Yes. Maybe what you're thinking when you looked at it, like short call means you have the obligation to sell. I'm not sure if that's where that came from, but we're not focusing on the obligation. We're trying to get rid of our contract. And if you sell a contract with that's a call or put, that's always going to be a closing purchase in the end to get rid of it. That makes sense? So if we did a closing purchase, let's say at 2.
Okay.
What do we have in our hands now?
So we took in 5, but then this is going to be a gain of 300.
Good. So this would be a short-term capital gain of $300.
Okay.
That's it. Cool. So if it expires or if it's traded, all you really need to find is the overall gain or loss, and that will be almost always a short-term capital gain or capital loss. With the exception, with the course those exceptions that we talked up front with the leaps, with the long leaps. But that's it. That's it's not going to get more complicated than that.
Okay.
Okay. Cool. Before I move on to exercise, which is going to be probably the toughest one, but we'll get it. Any questions about trading or closing transactions? Okay, cool.
Pretty
So
safe.
yeah, let me screenshot this and I'll send that to you afterwards. But let me get in here. Let me do some erasing here. Okay, so we're going to jump over now to see what happens if we exercise an option. Okay. We're going to see how this is going to be pretty different than what we're used to with the expiration and trading, and that's mainly because whenever an option is exercised, there's not a gain or loss necessarily, but you're either buying or selling stock depending on what it is. Like if you're long a call, you're buying stock. If you're long a put, you're selling stock, and so forth, right? So you will be doing one of those things, and you're not necessarily establishing a gain or loss, but you may have seen this terminology before: cost basis and sales proceeds.
Yes.
Maybe we just pause there real quick. Does anything, like if I say cost basis, does anything come to mind for that?
What I paid for it.
Beautiful. Yeah, I think.
Total
Yeah.
what you.
Yep. That's it. So bottom line, when we go through taxes, I think some people just overcomplicate cost basis and sales proceeds, but it's as simple as you just said. Cost basis is what you paid for something. Sales proceeds is what you sold something for. Beautiful. That's it. Okay. So this is an area we definitely want to take our time, make sure we feel pretty good about it. So we're going to go through 4 examples here. We're going to make sure that we hit long call, short call, long put, short put. Okay, and understand what happens here. So let's say we go long one ABC Jan 45 call. Let's say at 4. Okay, and then the option is exercised. Okay. what I'll do is I'll walk you through the long call, and I'll show you kind of what my thought process is, and then I'll have you walk through the other three, or at least see how far you can get with the other three. Okay. So when it comes to taxes on options, when there's an exercise, we're always focusing on what we're actually doing with the stock that we're coming across, okay? Meaning that if we're long the call, that means that I am exercising my right to buy stock at 45. So we're buying 100 shares of ABC at 45, okay? And when I think, if I'm thinking, okay, exercise means I'm either establishing cost basis or sales proceeds, the question, whether or not you're establishing cost basis or sales proceeds is not based upon what you do with the option, even though they're both buys here. I bought a call, bought shares. But it's based upon what you're doing with the shares. That will determine if you're establishing cost basis or sales proceeds. Because we're buying shares, we're establishing cost basis, and we're going to start at least with 45. Okay, our cost basis is 45, at least if just through the exercise itself. But there's one other thing they also want us to involve, and we also want to involve the premium. Okay. The premiums are part of the story here, and whenever you exercise an option, they kind of smash everything into like just what's going on to the stock. So there is no capital gain in the event of an exercise. There's no capital gain. There's no capital loss for the option itself. It's just kind of folded into what's going on with the stock. So the customer bought 100 shares of 45. They bought stock at 45 plus they bought the call at 4. So I'm going to add 4 to that. Oops. I'm going to add 4. If I can type here, I'm going to add 4 to this. Our cost basis, in terms of what they're looking for in the exam, they would want us to make sure we knew if this happened and we bought this call and we exercised it, we would be establishing a cost basis of $49 per share on the stock. Whenever you have two like actions, meaning I bought the call and I bought the stock, whatever the cost basis or the sales proceeds is that you're dealing with will always be added. Now, if you see an opposite action, which will come across when we get to puts, like if I go long a put and I go, that means I'm selling stock, long put, if I exercise, I'm selling stock, that's where you would exercise because I spent money on the put, but I sold stock. And anytime you have two unlike actions, like a buy and a sell, a buy the option and a sell the stock, you're going to subtract the number instead of add. Hopefully that makes sense.
Makes sense.
Let me give you like one way that you can always check yourself to make sure that you're going through, that you've landed on the right number. I don't know how comfortable you feel with options in terms of like the single leg options, like if I buy a call and that's all I do. Whatever your cost basis or your sales proceeds is on the option after the exercise is always going to be the break even of the option by itself. Right, that's one way you can always check yourself. It's like for me, I'm always like, okay, I got a cost basis of 45. Does that match with the break even of the option by itself? Option long calls break even is strike price plus premium. Cost basis is 49 as well. Okay, another way you can check yourself. But ultimately, with calls, you're going to be adding the premium. With puts, it would be subtracting the premium. It's all about, are you doing the same thing with the option in terms of buy and sell that you're doing with the stock? Okay. All right. Cool. Let's go through a couple examples. Let's go through we'll go short call, long put, short put as well. So on the right hand side, let's just do this. Let's do a long or short one. BCD, February, let's say 60 call at, let's say 6. Okay. And then the option is exercised. So let's think through, okay, if you sell a call, what's going on there? What are we doing?
Okay, so we sold a call. So we took in $6 for the obligation to sell stock.
Yep. So we're gonna have to sell 100 share. We'll be selling 100 shares of BCD at 60. Okay, cool. And we took in that $600. So I'll let you take it from here in terms of the tax consequence.
Six. Okay, so we sold. So we have sales proceeds
Good.
of $6,000.
Mm-hmm. I'm just gonna do. I'll just do it on a per share. But usually they'll ask you this on a per share basis. But yeah, we'd have sales proceeds of 6,000 overall. About 100 shares, it's 60, which would be 6,000. I'll even put that to the side. Okay. What else do we have to do here?
We also sold it. So we also took in a $6 premium.
Mm-hmm. Okay.
So that's going to be another sales proceed
Mm-hmm.
of $6. So you're
Yep.
going to add.
Options terminology, that'd be 600, right?
Yeah.
So our sales proceeds here would be $66 per share, or an overall $6,600.
Okay.
Beautiful. That's it. Cool.
Okay.
We, again, if you want to go back and check the short calls, the break even is strike price plus premium, which is 66, and that matches up with what we found for our sales proceeds. In case you're looking at this later and just like, what is SP, what is CB? Let me just write this up here. So CB is cost basis, and then SP is sales proceeds. Yeah, these are two things the IRS is always looking at to figure out, did you make money or did you lose money on something? Cost basis, sales proceeds. It's cost basis, what did you pay for it? Sales proceeds, what did you sell it for? And then kind of going from there. So cool. Let's jump over the puts, which puts are a little bit different, but same idea. You still approach it the same. So let's say we go long one, XYZ, let's say March, just for flavor here. March, let's say 90 put at, let's say 7. And then the option is exercised. So what's going on here? What are we doing?
All right. So we bought the right to sell.
Mm-hmm.
So we paid. So we have a cost basis there from the premium of $7, but the stock, okay. We definitely have a cost basis of 7. I know that from the premium.
Okay.
Long put. So we're selling. Oh, we're going to have sales proceeds
Good.
from the option
Mm-hmm.
of 90.
Okay. So, if when we exercise, we'll be selling 100 shares of XYZ at 90. Okay. Good. So, like you said, we're establishing sales proceeds, and we know that 90 is going to be in there, right? Another, 9,000, right? Okay.
So we've got sales proceeds of 90. But we spent 7 on the option. So that'd be a cost basis of 7.
Yes, but it's not going to be. We spent money on the option, but instead of it being just a separate like cost basis, they're going to include it as part of sales proceeds here. So the
We
question
just subtract it from the sales
you
proceeds.
subtract it. Beautiful. That's what you're doing. So 7, which is another way of saying $700. That's all you're doing. That, yeah, it's not going to have a separate cost basis, but yeah, that's it. We just have a sales proceeds of $83 per share here, which would be just another way of saying $8,300. That's it. Move this stuff over a little bit so we can get some room.
Now, which one's a capital gain?
Like, where would capital gain, capital loss show up?
Yeah.
Not here. Well, let me also say this. It depends on what happens in the question. Meaning that like if we look at this, the options exercised, we know we have sales proceeds of 83. The question is to figure out like what's the end of the story here is, well, they sold 100 shares of XYZ. Well, what do they buy them for? So right now, what we're doing is we're focusing on what the tax consequence is of the exercise. If the customer bought these shares in the market like months ago at like $60 a share, then we would have a cost basis of $60 per share, and then we just compare that number to this number to figure out what the overall capital gain or capital loss is. And what I'll want to do after we're done here to make sure that we've really understand this is to go through a few questions that involve the taxes on options, because I think that'll really help with submitting this. It just there's another side to the story that we're not talking about here, because that's if we're just simply talking about the tax consequence of the option itself, all that really matters is this, if that makes sense. All that matters is what we're going through in terms of the exercise.
Okay.
Okay, cool. Let's try one more. We have one more to go through. It'll be our short put. So say we go short one, MNO, just making up names. April, let's say 70 put at, I don't know, 4, 5. Let's do 5. Okay, so we go short one, MNO, April 70 put at 5, and let's say the option is exercised. So let's think through what happens if it's exercised and what does that mean tax-wise?
That means we have to buy shares at 70.
Mm-hmm. So we'll be buying 100 shares of MNO at 70. Perfect.
So we're buying, that's going to be cost basis.
Good.
So we have a cost basis of 70 from that transaction.
Good. 70. So that'll be $7,000, right? $7,000.
And now, but we also have the fact that we took in $5.
Mm-hmm.
So we're just going to subtract
Good.
5 from the 70.
Good. Be what, $500? You got it, man.
Cost basis 65.
Oh, oops. 65 per share, which would be another way of saying $6,500 overall. There you go. That's it. Those are your taxes on options. And what I'll do, just in case, if you look at this later and are running into any kind of problems, let me write this up here. I think the thing that people struggle with the most when it comes to taxes on options is just, what to do with the premium. So just in case you look at this like 3 days later, like, I can't remember what we talked about. There's multiple things you can do that you can think about here. If it's a call, add the premium. If it's a put, subtract the premium. And then lastly, the ending cost basis or sales proceeds should equal the break even, option break even. Okay, so we'll put that there. I mean, simple math. Just add the premium if it's a call, subtract it if it's a put. That's kind of the way I think about it. But there you go. Screenshot that. Do you want to see if we can find? There are questions that are more difficult than what we just did here. But if you know how to do what we just did, it should at least give you a good fighting chance to get to the right answer, depending on the question.
Let's go into question.
Let's go through a few. Let me bring up Kaplan. Let's jump in here. All right. All right. Let me share the screen. Oops. All right. What is this? Is this a 7? Yeah, 7. So 7 top off. All right. So to be honest, I don't really know where. Oh, tax rules for options. There's a whole section of them. Okay. All right. Let's see what we can find here. Let's start. I think this is not a bad one to start with. Now this one does combine. It combines what we just talked about, but it adds an extra layer in there with like buying stock. So I'll see how far you can get on this, and I'll shut up. I'll let you try to make your way through on this one.
Customer buys 100 shares at 57. Then sell a call. As exercised. Who's that? All right, so the option, so the call's been exercised, so that means
Mm-hmm.
we have to sell stock.
Okay, good.
At 60.
Yep. We'll be selling 100 shares at 60. Okay, yeah, you're right. Okay, so what does that sound like to you?
That sounds like selling it. That's sales proceeds.
Sales
60.
proceeds. Okay, so we know sales price is 60,
But
but
we also took in another 2.
beautiful. Sales proceeds 62. That is one of the right answers. 4 is one of the right answers. Okay.
Okay. And then we're gonna have a cost basis of $56.50. That's what we bought the share.
Beautiful. That's it. So they just added the extra layer there of like buying the stock before, but sure enough, yeah, we cost basis of 56.50, sales proceeds of 62. Yeah, just think through the extra. If you're really comfortable with the exercise, think through the exercise first, and then go back to the shares, just like you did. That's it.
It's
That's it.
just 2 separate transactions.
Yeah, 2 separate transactions. Exactly. Yeah, and like in terms of the IRS looks at this and they would say, okay, you bought these shares at 56.50 and you ended up selling these shares for overall 62, and they're involving the premium in there. So this customer overall would have a capital gain of what? 550, if I'm reading that right?
Yeah.
Yeah, something like that, right? So
Yeah,
that's it.
because
Okay, cool.
it'd be
Any
short
questions?
term.
Yeah, short term for sure. Any questions about that?
No.
Okay, cool. That's it. Right. So you did really good on that one. Let's just do number 2. Let's look at that one real quick.
If a customer. Okay. So we wrote up. Okay. So if a customer writes a 1 ABC November 60 put at 350, and the put is exercised. ABC. The cost of. All right. They're just trying to trick you by throwing in when. It doesn't matter. So ABC at 57.50. That just does not matter.
Yep.
So we sold this option. It's been exercised. It's a put. So that means we have to buy stock.
Mm-hmm.
We're going to buy 100 shares at 60.
Okay.
But we so we have a cost basis 60 there.
Yep.
But we took in 350.
Mm-hmm.
So it's going to be minus 350.
Good.
So that's going to be 56.
56.50. You got it, man. That's it. That's it. Let's just double check our work real quick. So 56.50, and sure enough, God, come on, computer. Sure enough, it should be 56.50. Yeah, there you go. Yep. You're doing great with these, man. I'm just gonna keep going through these until you tell me that you feel really good about it. But let's.
Which of the following transaction in the same security will affect the holding period of a security held for 12 months or less? It's going to be the sell. Well,
This, by the way, this is separate than what we just talked about, but definitely something that could show up.
which of the following transactions in the same security will affect the holding period? I imagine it's going to be when you're selling.
Yeah. Well, one of the answers is one of the cells.
When the result of the option is you selling.
Okay.
I don't know if I'm.
No. Yeah. You're right. You're right. And this is I don't know if this will.
Is it one of? No, it's not one of the options. That's a problem.
Yeah. No. I see. No. I mean, I think you're saying the right thing. If
I
you
don't.
the married put. You remember reading anything about that?
Yeah.
Yeah. So a married put is when you'd be buying stock and buying a put on the same day, the same, basically doing it on the same day. And when you do that, it's basically like even though you're dealing with two separate securities, one option, one a set of stock, they basically will smash those two things together and treat it like it's one big thing. If that makes any sense, meaning that your premium on your put is added to the cost basis of the stock, and it's just kind of treated as like one big thing. Okay. Now, if you buy, I'll give away one of the answers here. One of the answers you're looking for here is one. If you buy a put on any day other than the day you buy the stock, which could be the next day, it could be 3 months later, it could be whatever. But if you buy that put on any other day than the day you buy the stock, then that put purchase will, what the word that they'll use is toll, Toll. It'll toll your holding period, which is another way of saying like it freezes your holding period on the stock specifically, right? Everyone if you're selling stock at a gain, everyone wants a long-term capital gain because it's taxed at a lower tax rate. Sometimes it's more than half of your normal of the short-term capital gains rate, right? Like if short-term capital gains is up to 37%, the long-term capital gain rate is anywhere between, it's either going to be 15 or 20% depending on what type of taxpayer you are.
Or
So
zero.
The long-term?
Yeah, fear. It
Yeah.
can be.
Yeah, I think in certain, are you talking about like for
If you're in the 12%.
Yeah, hang on one second. One second. Hello, can you still hear me?
Yeah.
You can hear me? Gosh, hang
Yeah.
on. Just unplug myself.
There.
Yeah,
Now
there.
it's-
Perfect. So yeah, I would say I think you're right. Real world, test world, you want to assume that just pretty much in every circumstance you're going to have a 15% tax rate at the very least with a long-term capital gain. Okay. So, but with this question here, one of the answers again is the buying the put. What they're afraid of is that this is what people used to do in the past before this rule was in place, is let's say you held stock for 11 months and that you really wanted to sell it because you think the price is going to go down, but you know that if you sell it today, 11 months into your ownership, that you're basically you're basically locking in a short-term capital gain that's taxed a higher bracket. So what some people would do is they buy a put just to extend their ownership on the stock, and they knew at the end of the day, like even if the stock price drops, I still can sell at that higher price. The IRS is pretty stringent when it comes to the holding period. So what they're going to say is that if you buy a put on any day other than the day you buy the stock, your holding period freezes until that put is gone, until it's expired, you've closed it out, or any of those. So with me saying that, does that make sense what I'm saying? Do you have any questions about that?
That makes sense because you're selling the stock.
Yeah. You're buying. You're basically, this is just one of those things that if you're going to get a question on it, it's literally going to be one question. Just know that buying a put is one thing that'll affect your holding period. The other answer they're looking for is 3. selling short, which sounds like yeah, I'm going to put this term up on the board here. Have you ever seen this short against the box?
No.
Okay, this is something short against the box means that you are long 100 shares. It doesn't have to be 100, but you're long shares and you're short shares at the same time. Okay, long shares and short shares at the same time. So it sounds bizarre, but a lot of people, like when I tell them like this is short against the box and this is something that some people do, people always wonder like why the heck you would do this, right? Like it doesn't really make any sense on the surface. Why would you go long bullish shares and short bearish shares? I mean, it doesn't matter where the market goes. If the market goes up, you're not making or losing any money because they offset each other. Long stock is making money as a short stock loses money when the market goes up, and vice versa, right? People go short against the box to defer taxation. That's the number one reason why people do it. Probably the only reason why people do it. So let's say that you're at the end of the year. Let's say it's like it's December 2019. Okay. Let's say that you want to lock in whatever gain or sale that you have, or like whatever gain it is you have. Let's say that we have a gain on paper. We want to lock it in, but we know that we don't want to sell it in the year 2019 because maybe our taxes are crazy this year. Well, you could go short the shares, and by going short the shares, you've basically locked in your gain or loss at that point in time. Like it doesn't matter where the market goes because just the shares just offset each other, and you can basically do that. And then when 2020 rolls around, close out both positions, and now you have a tax event in the year 2020 and not year 2019. So short against the box can be used to defer taxation, but it does not stretch out your holding period. So if you go short against the box, basically your holding period effectively goes to zero when you do that. It's like you haven't even held the shares for a long period at all. But for people that were already had a short term whatever it was, and were more concerned about pushing their gain or loss into the next tax year, it doesn't really matter to them. So again, going short against the box will affect your holding period. Effectively, it'll, instead of just pausing it, it'll bring it all the way down to zero. But again, this is not the biggest topic in the world, so I don't think we should spend too much time on it. It's literally maybe one question, but buying a put and selling short stock against a long position in your account, those are two things that will affect your holding period. Nothing else will.
Okay.
Okay, cool. Um, any other? I know I went through that pretty quickly, but any
No,
questions about that? Does that make sense? Okay, cool. All right. Um, let's look at this one real quick.
Okay. If a customer buys one FLB October 50 call at 3 and she exercised the option, what is the cost basis of the 100 shares? All right. So she exercised the call, so that means she's going to buy 100 shares at 50.
Mm-hmm. So put that in there. Buying 100 shares. 50, good.
That's cost basis of 50.
Yeah, they even give it to us in the question there, right? So we know cost basis is 50. Okay, cool.
And we spent 3 on the premium. So
Okay.
that's $3, another 3 added. But they want the whole position. So it's A. It's 5,300.
53, so it's 53 per share, or another way of saying 55,000. That's it. Cool. You got it, man. You're doing really well with these option questions. Let's just double check, make sure we look good on that one, and sure enough, it should be. So 5,300. That's it. Good. I say this. I know they have a couple tough ones in here. Let's see if I can find a tough one, and then we'll see where. Oh, let's look at 9. That one doesn't seem too easy. Let's see.
Whoa.
Yeah.
Okay. So let's just break it down. So we sell one TCB put. And buys. Um, so he sells the. And he subsequently sells
Mm-hmm.
put. So he traded the put.
Traded the put. And what do you mean? What do you remember about trading an option? Excuse me.
Well, you can. You're gonna have a. It's gonna be a capital gain or a loss.
Mm-hmm. You looking at A?
Yeah.
Yeah, I agree with you. A should be the answer, and we'll double check too.
Because I'm trying to look at the passive income or loss. No, it's not treated like that at all. So that's just a
Good,
throwaway.
good.
But the other two are long-term capital gain. It was never. It's not gonna. It can't be because we got short involved. We're selling. Well,
Yeah,
well, they're not leaps anyway, so it doesn't even matter.
doesn't even matter, right? They don't tell us.
9 months or so it can't be either of those because both have them long-term in it.
Yeah, for sure. So ultimately, this is a just a process of elimination, at least the way I look at it, right? We know, when you trade an option, it's either going to be a capital gain or capital loss. The question is how much, right? While we're looking at B, just real quick, passive income or loss, you're right. That's a completely separate world. But does anything come to mind when you see passive income? Does anything come to mind with that one, or like what would create passive income?
Is that DPPs?
Yep, DPPs and real estate rental income. So if you had a real estate property that you rented out, made money off of that, that would be considered passive income. Those are the two things you need to worry about with passive income. So good.
Oh yeah, because if you're a limited partner, it's passive income or passive loss because you're not involved.
Yep.
Right? Am I thinking about that?
Yep, you're right. You're thinking about it the right way. Perfect. That's why they call it passive.
The general partner would have. It wouldn't be passive. It would be active.
Yeah, it's categorized in a different way, which the test never talks about. And to be honest, I think it's one of those things that's just a little bit more complicated than it might seem on the surface. But yeah, that's the idea. Test is never going to talk about it though.
Just know that because you're the limited partner, it's passive because you're not involved in the company. The only thing that you're involved with, you can be a creditor though. I missed a question on an STC thing. If you're a creditor.
What do you mean by that?
Oh, I'll pull it up on the question.
Yeah. Let's look at it. Cool. So no, you're right. But yeah, on this question here, you're doing great on that one. So cool. Do you? I'll leave it up to you. Do you want to look at more of these tax consequence questions, or are you feeling pretty good about it?
I think I'm feeling pretty good about it.
Yeah, I think you're doing great with them. I agree. So where do you want to go from here?
I'm pulling up my one of the finals.
Yeah. Do you want me to look at your screen or no?
Yeah, I'm gonna pull up the ones that I missed. Yeah.
So I'll stop sharing my screen. You'll have to share yours. Do you remember? Let me know if you're running into trouble doing that though.
Share screen. Is that? Oh, I can. Okay.
See it? Yeah. I can't see your screen yet, but yeah, wherever my face is, there should be a green button that pops up after you scroll over my face. At the bottom it says share. Got it.
Okay. Can you see that?
I can see that. Perfect. Okay, let's look at it. Yeah, I think it's a good idea for us to go over some of the things that you maybe struggle with a little bit, but you want to look at this one first?
Yeah. I
Okay.
just see. Here was my first. I'm
Okay.
noticing about 100. It's not taking me that long.
No, it's not, and
So
which is good. Yeah.
time isn't going to be a problem.
It's not going to be a problem at all. In fact, like if that's the case, you might, I don't know. Some people like to go back and double check their work. I mean, you don't necessarily have to, but just in case there was a mistake, you missed a word somewhere there, it might, if you have so much time left over, it might be worth it to go back through them again. It'd be a pain in the butt, but you could do it. Um,
Okay. So one of the things it was telling me was let's
Communications,
just go through. Yeah. Let's see. Like
like
where I'm.
public, yeah.
Um,
Um, so customer sells 1,000 shares of stock and asks for the actual time of execution, which they can ask for, and we can give them. For a branch office manager, was appropriate action. I
See,
see. I see.
I thought it would be on the order ticket the time that it went through.
Yeah, it would. So it would. You're right. But the order ticket is something that's almost always kept internally within the firm.
Okay.
You might be thinking about trade confirmation, possibly.
Okay. Yeah.
Even and I have to think about it too. I think the trade confirmation. I don't think I've even seen a question list. I'd have to actually go to my Fidelity account real quick just to see if I could find it. But on a trade confirmation, I don't even think they're going to tell you the specific time the order went through. They'll tell you the day it happened, but they're not going to tell you the specific time it went through. But bottom line is, if a customer calls and asks for the specific time of execution, you can give that information. The state the firm is able to provide this information in written request. That you don't have to do it that way. You can actually give it to them verbally, and that's something I used to give the clients over the phone. But I think maybe that's a good general answer there. It's probably the best of the four. B, it's not impossible to know the time of the trade. The firms keep all the stuff on file. And then D, to indicate the customer should contact the equity trading department, no, or desk, I should say. No, I mean, just you can do this. If a customer asks for the information, they can get it. There's just depending on the firm you're at, you might have a different policy. But that's A is your best answer there, if that makes sense.
Mhm.
Order tickets are internal. Trade confirmations go to customers.
All right.
Okay. Okay. So
It
this is a
makes sense to me
good one
now.
to look at. So what?
It makes sense to me now.
Yeah, I would also tell you here, it's no mistake that A, B, and C, which are all not the right answer because they're looking for the except or the not there, they all have the word district in there. Districts are almost always like if you ever see a district, library district, police district, fire district, school district, park district, that's almost always that's code language for that there are multiple municipalities paying into this thing, and there's people like I remember from school back when I was a kid, they would bus in kids from all different parts of the city, right? Or all different municipalities sometimes. So that's what a district. Whenever you see district, you should think overlapping. I'm also going to throw, sometimes the 7 is a big vocabulary test. I'm going to write this word. You may have seen this word. There's another term for overlapping debt. If I can spell it right, you might have seen that word somewhere.
I don't know if I can see.
Coterminous. Can you see that on your screen?
No, I can't see.
Oh, you can't see me at all? Okay. The word coterminous is another word, just a synonym for overlapping debt. So you might see that coterminous, Coterminous, coterm-us.
Okay.
Yeah, so I think some people see that on their exam and freak out, but yeah, that's it.
But it's the whole definition of overlapping debt is
What they say only involves general obligation borrowing. Okay, so they took like a weird angle on it. Overlapping debt in terms of what I was saying there, overlapping debt is when multiple municipalities pay into the same thing. They like take on a debt and they kind of share a debt together. That's where they get the term overlapping. But yeah, it's only going to involve general obligation related things, so things that are beneficial but don't make money.
Okay.
Yeah, but yeah, there you go. Which of the following statements is true? We're going to back in sales charges to customers. Okay. So looking at this one, oof, this one's tough. I mean, looking at it now, do you get what they're trying to say there?
Kind of.
Yeah, I mean, to me, I think a lot of these questions are just process of elimination. I mean, there's not like a big rule necessarily to remember, but like, number one would be that's the first one I throw right out the window, right? As long as back end charges are clearly disclosed, well, whether it's front end or back end, those are loads, right? Or another way of saying sales charges. So that's hopefully that makes sense. They'll be out the window. It also a statement in the prospectus is sufficient. Maybe that's another one you're looking at, but no, you have to disclose sales charges to your customers pretty proactively and pretty explicitly. Then we look at D. Disclosure is required in addition to that. Wait, disclosure is required in addition to that in the prospectus only if the broker dealer, what am I even saying there, and mutual fund are affiliated through common ownership.
I was confused as can be with this
That
one.
almost, yeah, that sounds real confusing in terms of what they're saying there, but I don't know. It's just, here's the deal. When it comes to a back end sales charge, you want to be very explicit with your customers. It's a best practice. You're telling your customers verbally that it's going to be there, but also it should be on their trade confirmation once they receive it afterwards. Confirmation should be sent disclosing sales charge. Maybe you have to pay it upon redemption. Um, yeah, that's the idea. You got to be very explicit. Best way to get it to them is send them written confirmation of it. Yeah. Showing indicators is bullish. Okay.
It makes sense now. The bottom
Okay.
of the stock, that means that you think it's hit the bottom. You think the stock's at the bottom and it's about to.
Good.
Yeah.
Good. The saucers. You feel good about the saucers and the head and shoulders and all that stuff.
Kind of.
Okay. Yeah. I mean, what I would tell you to do with these, I mean, saucer. God, I'm gonna try to. You don't.
Hey, I can see that.
You can see that. Okay, good. So that's kind of that's what a saucer kind of looks like. It just we don't have to be too technical here. The thing that you're always looking at when it comes to any of these patterns is that, yeah, it might seem like you're starting in the same place that you're ending, but it's not focusing on that. It's focusing on where we headed, right? And because we're headed upward, they would call that a bullish trend. So that's a saucer. That's what they would call a this would be a regular or just a saucer pattern. If it was upside down like this, you'll see this on your screen in a second. If it looked like that, that's an inverse saucer, and that would be bearish.
Okay.
That makes sense. Okay.
Then you have support and breakout, right?
Yes. And actually, I was drawing this in your screen. Just head and shoulders. You just need to know that that's, this would be bearish. This would be what they call a head and shoulders top formation, and that would be bearish, if that makes sense. And it's all about where we going, okay, where are we headed to, okay. But yeah, I mean, in terms of what you were saying there, let me clear all that stuff out. The breakthrough.
That's the top. And the support, I just look at the support. It's the foundation.
Yeah, exactly. So it's. I mean, I probably don't even need to draw it. Sounds like you get it, but resistance and support levels. The breakthrough is if you either go above the resistance level or below the support level. That's
the
it.
reason why I thought decrease in short interest is because I thought, well, why would you short something that you think is going to go up?
Yeah. Okay. So what they call the short interest theory. There are a few bizarre technical analysis theories that you have to know for the exam, and a lot of them are kind of counterintuitive. At least short interest is very counterintuitive to me. But I think I'll give you some justification. Sounds like sounds like you knew what short interest was. Short interest is just the amount. Like every stock will track how many of their shares are being sold short. right? Like so a company that has a high short interest is just another way of saying this company has a lot of people short selling its stock,
Mm-hmm.
right? So that's essentially what short interest is, the short interest indicator. But here's kind of the thought process with this. Let's say you pull up a stock and let's say that 90% of their shares are being sold short, which sounds terrible, right? It sounds like that, like how could we ever call that a bullish indicator? And that would be like an increase in short interest or high short interest would be a bullish indicator. The reason is because all those short sellers have to buy back that stock, right? Like their sale price is already factored in. Their sale is factored into the price of the stock. You're telling me that 90% of these shares outstanding have to be bought back in the next, I don't know, however many days, or it has to be usually short positions don't last that long because there's a buy waiting to happen after a short sale occurs. Buys increase demand and demand increases price. So at least that's their thought process. Short interest is a very counterintuitive theory. High short interest is bullish. Low short interest is bearish, which sounds weird. But,
What's the
but
one where you're doing what the opposite of people are doing, where you don't think
that's the odd lot theory. That's a fun one too.
the odd lot theory?
They call it the odd lot theory. Now, if we just say the term odd lot or round lot, do you know what we're talking about?
Well, round lot's 100 shares.
Yeah. So odd lot is anything
Odd
less.
lot is something in a multiple of 100, so it could be 425s,
Yeah.
right?
Yeah. I mean, yeah, an odd lot is anytime you see like a round lot would be 100, 200, 300, 400. And odd lot is really anything other than that, right? Um, so a lot of times when they're talking about the odd lot theory, they're really talking about people who are buying like 13 shares of stock or 43 shares of stock. And in general, it's your less sophisticated people that are doing that, if that makes sense.
Uh-huh.
Oh, the thought process is let's look at a chart. Let's just pull up a chart that tells us what all the odd lot, what all the customers who are buying and selling odd lots. Let's figure out like in general what they're doing, and let's just do the exact opposite of that. It's kind of a mean theory, but it's a theory that the small retail investor has no idea what they're doing, so you just do the exact opposite.
Okay.
Some people subscribe to it. It doesn't always work.
Okay.
I've tried it a few times, but yeah, there you go.
This one I know now.
Cool.
EC, it's an anonymous.
Okay. Yep. That's it.
I'm not 100% on ECN, so
I mean, you see, like if you remember reading anything in the secondary market, like the fourth market in particular, I don't even know if they mention it anywhere in there, but the fourth market is where institutions trade.
yeah.
A lot of times, in the market with retail investors, everything's very transparent, and we can track trades to wherever. But in the institutional market, it's very shrouded in darkness. In fact, you may have even heard them talk about a dark pool before, right? ECNs are kind of allow that activity to happen. So, yeah, if you want to trade anonymously, you have to be an institution, and the idea is that the sharks can deal with the sharks there. Yeah.
Okay.
Okay, CMO suitability. Wow, I don't think I've ever seen a CMO suitability question, but okay.
Welcome to STC.
Getting you ready, right? Maybe I've seen like one or two in the past, but they're not very common by any means. But CMO, the mortgage-backed security, right? If I buy into a CMO, I'm buying into a tranche, and I'm essentially receiving mortgage payments from homeowners. Okay. So when determining a CMO is suitable, a registered representative must offer to the client all the following information except.
I screwed it up because I didn't completely read it. Currency rates have nothing to do.
Yeah, I mean that would be. I mean,
Everything else has something to do with it.
yeah, that's a tough question there for sure. But yeah, I mean, currency rates, you only need to worry about that when you're dealing with some kind of international investment or foreign investment. But yeah, not here. Everything's
ADR or something of that nature.
well, yeah, I guess with an ADR, you could probably get away with not talking about currency, even though currency does factor into things and behind the scenes. What you're really looking for there is like if you're buying like a foreign bond or something like that. Yeah,
Okay.
yeah, exactly.
That's just
Yeah.
that's just me forgetting that it starts at the BA.
Yep.
That,
There you go. Triple B to double B. Yep, triple B is the lowest investment grade, and double B is the highest speculative grade. And just Moody's uses this weird BAA system, but yeah. S&P and Fitch would be BBB to B.
Theirs is
Triple B to double B. Yeah.
Theirs is easy.
Yeah. Yep.
I know why they threw Moody's, because it's just different.
It's different. You're right. Investor writes 3 uncovered.
Messing up the math.
Okay. Yeah, usually probably just forgot to multiply times 3, right? Yeah, that's it. Exercise price of a listed stock option are not adjusted for. Wow, that one's tough.
I get it, kind of.
Yeah, that one's really tough.
Cash dividends aren't going to affect it.
Yeah, well, here's
Technically they could, because it's going to affect the balance sheet.
Yeah, I mean, I'm also going to give you an exception to this question, and this exception I'm about to say, just keep it in the back of your mind. This is very lightly tested, so this is not the most important thing in the world to remember, but it's possible you see it. Cash dividends are not stock options contracts are usually not adjusted at all for cash dividends. However, if it's a special cash dividend, which you don't even really need to worry about like where that comes from. A special cash dividend is just a cash dividend that's paid by a company that usually never pays a cash dividend. Like Apple did this like 4 or 5 years ago, where like Apple never pays a dividend. Then there's one point in time where they had more cash on hand than the U.S. government. And they just had no idea what to do with it, so they paid a one-time special cash dividend. That cash dividend did adjust their stock option strike prices, and they just adjusted them down by the amount of the dividend. Otherwise, if it's just a regular cash dividend paid by a company that regularly pays cash dividends, nothing's adjusted. Like the option contract stays the same. But if it's a special cash dividend, that's the one exception to this answer here.
Because all of those, other than the cash, would change the price of the stock.
Yeah. Well, I mean, here's the thing. Cash dividends will change the price of the stock too. That's the tough part, right? Like, I mean, if a company pays a $1 per share cash dividend, the price of the stock is going to drop by $1.
Uh-huh.
It will. It's just the idea there is that even though there's a cash dividend being paid, it's in the end of the day they just don't feel like it's that big of a deal to make a big adjustment on option contracts, so they just don't. It's to be honest, I think it's just pure laziness on their behalf. They just don't want to deal with it, so they don't do anything about it.
Okay.
That's it. Yeah.
I think my thinking was the rights offering is anti-dilution.
Yeah, it's anti-dilution. You know, I've never seen them mention rights offerings, having an impact on stock options, but they do. I've never seen them mention it before, but yeah, they're right. So, yeah. Investment banking. When I see investment banking, by the way, the first thing that comes to mind for me is underwriter. You know, an underwriter. You know, this is a company that's hired to sell securities on behalf of some company. So investment banking principal, so a supervisor in this company, has received a letter from a customer complaining about a recent new issue. So it's a letter, so it's a legitimate complaint that we have to do something about. That declined substantially on its first day of trading. Client purchases shares based on a recommendation by associated person of the firm. Question: when did that recommendation come into play? If it came into play during the cooling off period, that's a problem. Customer contends that the recommendation was unsuitable. Which of the following statements is true? This is all like questions like these are always process of elimination. Customer complaints, you might get a record retention question on them. Do you know that complaints, there's actually 2 separate time frames depending on if we're talking about FINRA rules or MSRB rules. And if they don't mention it otherwise, you usually just want to assume we're talking FINRA. Do you know what the record retention requirement that FINRA has for customer complaints?
Is it 6 years?
It's 4 years.
4 years.
4 years. FINRA's rule is 4 years, and this is why I think this question is really hard. Is FINRA's rule is 4 years, but MSRB is 6 years. I really don't think you're going to see that MSRB question, but if you're a firm if you're dealing with like municipal related something, and a customer sends a complaint to you, you got to keep that complaint on file for 6 years according to the MSRB. But if it's anything other than municipal related activity, then it's just 4 years.
Okay.
That's why A is wrong. So customer complaints have to be kept in file for 4 years, according to FINRA. B, the principal must review the complaint and submit a written response to the customer. So the principal must review the complaint. Yeah, that's true. Like they've got to review it with the registered representative and submit a written response to the customer. That's not a bad answer. I think maybe it's the second part, the needing to submit a written response. Maybe the principal doesn't necessarily need to do that, but B is not a bad answer. C, a memo must be prepared describing any action taken in response to the complaint. Yeah, that's something I'd love to see their. I'll have you show me their explanation here in just a second. But like D, the firm must enter promptly into arbitration with the customer to determine whether a reimbursement is warranted. Yeah, I mean, arbitration is one of those things that's going to come into play if the customer and the broker dealer can't come to a decision together. Like if they can't amicably like come to a decision on what's going to happen. It's not the first thing you're going to jump to, if that makes sense. That's where like you're at an impasse, broker dealer and the customer just don't believe that either one's doing the right thing. And you know, I don't know how much. Do you? What's your level of comfort with arbitration and what that's all about?
I'm not super confident
Okay.
with it.
Yeah, I mean, every arbitration is, to me, I think the easiest way to think about it is just like it's your most it's like an efficient way of suing, of like handling a lawsuit. So even though they'll say it's voluntary for customers to sign this thing, every single finance customer of like a broker dealer or any kind of financial firm makes their customers sign an arbitration agreement. We did it at Fidelity. I'm sure your firm does it. And just if you're wondering whether or not they do it, just take a look at their new account application. It's usually somewhere in there. But firms typically have their customers sign these arbitration agreements, which prevent their customers from suing them. But it doesn't mean that the customer can't come after them in some way. FINRA just runs this arbitration. They have a whole a segment of their organization that's just dedicated to arbitration. It's basically like a lawsuit, except FINRA oversees it instead of the court system. That's kind of the way I would think about it. Only going to get there if you can't agree with the customer in terms of like if the customer wants like X, Y, and Z, and the broker dealer is not willing to give them that stuff, then the customer can take them to arbitration. Can't sue them, but they can take them to FINRA arbitration. And FINRA is very customer friendly. A lot of times broker dealers want to avoid arbitration if they can because they know that FINRA is probably going to rule against them. They almost always do. So if we look at the answer here, all written complaints must be reviewed by principal, yes, and must be kept in file along with a memo describing any action taken in response to the complaint. There's no requirement to respond to the client in writing or to enter arbitration or mediation. So it was the writing part that was a problem with B. I think that's best practice, is that you're always going to respond back to your customer and just say, hey, like this is what we're doing. But here's the thing, like if it's a crazy complaint that makes no sense at all, technically you don't need to respond to it. You just need to say you reviewed it. This is what you did. Okay. Which 5 factors is not taken into consideration when determining markup on a municipal securities transaction? Yeah. See, I get it, man. The first time I saw that, I'm like, how is that even a determination? But it is, and it's only for municipal stuff. That only shows up in MSRB. We'll never see that with FINRA. We'll never say that.
I was gonna say because I'm thinking market makers. They don't give a shit.
Yeah, exactly. In the municipal world, one of the things that you can take into consideration is the fact that the dealer is entitled to make a profit. That's one of the things that you can factor in. They will never factor in the financial condition of a customer. They feel like that could potentially be classist, if that makes sense. So I don't think this is a really, really important question, but yeah, that's that. Logan has a falling position, so we got an option account. Long the DEF 35 call, anticipates a slightly bullish move from DEF from which he wants to benefit, but also wants some income generated to reduce the cost of the position without adding additional risk. He could accomplish this by adding which of the following positions to his account. Yeah. I mean, this comes from the other area you want to touch base on. This is a spread, right? The customer is essentially creating a spread.
Mm-hmm.
So I think first and foremost, I mean, it didn't really help. The first thing I looked at in this question is that, okay, they want to generate income, so they want to, that means that's key word for they want to sell an option, which you look down at AB, it didn't help you in this one, but at least looking at it, okay, want to sell an option doesn't really help. But by selling that 45 call, they're really not, they're doing two things at once, or really three things, I should say. Number one, they're generating income. I know you know that, right? When they sell, they'll collect the premium. Number two, they're not really introducing themselves into any additional risk, because I know that we normally think, okay, selling a call comes with unlimited risk potential, but the reason why it comes with unlimited risk potential is because we don't know when or what price we have to buy that stock at. Like if we get exercised, like with that short 45 call, we know that if we get exercised, we gotta sell a stock at 45. The question is, what are we buying that stock at? And that's where the risk comes into play. But here's the thing: the customer's Logan in this example is already long that 35 call, so they don't have to worry about the risk that a short call usually presents. Okay. So by selling that call, it gives them income, doesn't introduce them into any additional risk. Here's the one drawback about selling that call, though, is that if the market goes above 45, it doesn't matter to Logan or the customer in this situation, because both the short call and the long call will start offsetting each other above 45. Does that make sense, what I'm saying there? Okay, cool.
Yeah, spreads limit you on the.
Yeah, it limits you on the top. Buying convertible bonds, common stock, which is converted, which in situations would produce a profitable arbitrage opportunity. Okay, so a lot of stuff in this question here just by looking at it. When they mentioned arbitrage, I don't know if we've ever talked about that.
That's the riskless return. That's where essentially I can buy something and literally turn around and sell it for a profit.
Immediate buy and sell, that you're basically buying and selling something almost sometimes at the very same time. I think in like the old world where people had this capability, people would see price differentials in different markets. Maybe like, the New York Stock Exchange is trading a stock at 40, and then the American Stock Exchange is trading the same stock at 41. So you buy a bunch of that stock on the New York Stock Exchange, and then you sell short a bunch of that stock on the American Stock Exchange. You're just making the difference between the two. That's arbitrage, like you said. So I mean, they're mentioning parity. This is a very tough question when they mention parity, and another area I can't remember if we talked about this. Doesn't ring a bell in terms of whether or not we talked.
Parity is where the price of the convertible bond is the stock if you were to convert it.
Yeah. So like
math to it.
Yeah, there's some math to it. I mean, let's just look at the right answer here. But the common stock price is at a premium to parity value, and the bond is trading at par. Common stock is at a premium to parity value. So, like, I mean, let's just make just add some numbers in here and just see if we can work our way through this. When they say the common stock price is at a premium to parity value, we're talking about, that means the stock price is higher than the stock's parity price. So I'm going to put this here. You'll see this on the screen. 1 second. Parity price of the stock is equal to the bonds market price divided by the conversion ratio. So again, you'll see this on your screen. Just 1 second. So let's just make something. Let's say the conversion ratio of 20. So parity price of the stock here would be. So I'll put this on your screen here. So the parity price of the stock is that formula. It's whenever you're looking for parity price, you always start with the market price of the other thing you're talking about. So meaning, like, if you're looking for the parity price of the stock, you're going to use the bond's market price to get there. If you're looking for parity price of the bond, you use the stock's market price to get there, and it's just always in conjunction with the conversion ratio. Like, I'll just to complete this one, I'll put the parity price formula for the bond above, and you'll see it's really similar. It's stock's market price times the conversion ratio. Oops, times the conversion ratio. That is the. Yeah, that's the parity price of the bond real quick up there. So just, again, if they ever talk about parity price, you can just kind of make up a number here. But if for what they're saying in B, And this is just one that might take you some time to think through and get to the answer. But the good news is you got plenty of time in this exam. You can take your time, right? If the stock is trading $1,000 and our conversion ratio is 20, meaning that we can turn our stock into 20 or our bond into 20 shares of stock, then if we do that, then we're effectively buying. It's like we're buying stock for $50 a share, right? Like I can buy $1,000 bond, turn that into 20 shares of stock, and by doing that, I'm really paying $50 per share. So if the stock price out is trading at like $60 a share in the market, then you can arbitrage, right?
Okay.
Buy the bond, convert it into stock, and pay $50 per share, and then take that stock and immediately sell in the market at 60. So I think these are just tough questions. If this is something that you're seeing yourself struggle with, then make sure you try to see as many questions in STC as you can. But I don't think you're going to see a ton of convertible bond questions. Maybe 2 or 3. Okay.
This is me messing up the math.
Yeah. Okay. Cool. We can keep going.
If you can see that.
Mr. Jones purchases Canadian dollar. Ooh. Okay. So
Yeah,
you want to look at this one?
This one just completely threw me.
Jeez. Okay. So this is a currency option question. I don't think you're going to see a ton of these. Maybe one. I think most people will tell me they don't even see a single one of these on the exam.
I'm afraid
Yeah. But if you see this, Mr. Jones Canadian purchases Canadian dollar September 85 call option. So
I know what the spot rate is and stuff like that.
Yeah, yeah. If you just go back up to the Canadian September 85 call, currency options are always in terms of US dollars. And it's even though there's not a decimal in there, they want you to assume there's a decimal, meaning that 1 Canadian dollar is equal to 85 American cents. That's what that call. Like with that call option, it means I have the right to buy 1 Canadian dollar for 85 cents. Okay. Or at least it's not just one. It's not 1 Canadian dollar. These, you don't need to know this, but they mention it here: 10,000 Canadian dollars per contract. I have the right to buy 10,000 Canadian dollars for 85 American cents per Canadian dollar. So basically, for 8,500 American dollars, I can get 10,000 Canadian dollars. Do you get what I'm saying there?
Yeah.
Okay. Now that's
away for the premium of 82.
Yeah, no, okay, that's the tricky part there, because the what I just said there about the right to buy Canadian dollar at 85 cents, that's the unique part about a currency option. But everything else with a currency option is pretty much as similar to regular options. So when it says it's a premium of 82 cents, that's a premium of $82 overall. Okay, that means that option costs 82 American dollars. Okay. It's just kind of a weird premium price there. But at what price, which is spot rate, would the Canadian dollar need to be trading in order for Mr. Jones to exercise the option and break even? If you can just treat this like a regular option as much as you can, which if you think about it, and I don't think you're going to get a bunch of random answers in here. I know you answered D, being 85, 80, 20, and that's strike price plus premium essentially, right? 85 plus the 82. But the answer is always going to look weird, like it does with C, where it's it's almost in decimal form there. So just take strike price plus premium, just like you do with a regular call option. That's your break even, and just know that it's almost always going to look like it's in cents, just like this. So I wouldn't be too concerned about that question. Not a big deal. Investor must pay accrued interest secondary market for purchase.
I screwed up with the T-bills because T-bills don't pay.
Yeah. Yeah, tax anticipation notes can pay interest. I mean, you look at A, B, and D; those are all zero coupon, essentially. Zero coupon bonds don't have accrued interest calculations. Investor's goal is to buy a security that establishes a fixed return for a long period with no reinvestment risk, which is obviously best suits investors' need. This is a good question. This is one that shows up fair amount. They want you to generally see, I haven't looked at the answers yet, but I'm sure it's some kind of either zero coupon bond or something like that. But if you're, the one thing that avoids reinvestment risk is a bond that just doesn't pay interest, right? If the bond doesn't pay interest, then there's nothing to reinvest. Does that make sense what I'm saying there?
Yeah.
Reinvestment risk is it's the risk you run into when interest rates fall, which normally people are like, well, interest rates fall, it means bond prices are up. Well, yeah, you're right. But also when interest rates fall, any interest you make off that bond has to be now reinvested at a lower rate. So if you're putting that money back into the market after you receive interest, then you're facing that reinvestment risk. So reinvestment risk applies to things that pay the highest amount of interest and the most frequent interest. So you might see a question that involves like a CMO. Like a CMO has a lot of reinvestment risk. Do you know why? If you had to guess, like CMOs,
Because of the mortgages,
right?
interest rates change so much with mortgages.
Well, yes, but also like I would think through like how often do CMOs pay interest?
No, they pay monthly.
They pay monthly, right? So things that pay the most frequent interest are going to have the most reinvestment risk. So that's the reason why in that one. But yeah, I mean, to go on the other end of the spectrum, zero coupon bonds don't have reinvestment risk, or at least we'll assume that they don't. So strips, long-term zero coupon bond. There you go. Following statements is true regarding separate accounts and general accounts.
This one took me a minute to figure out.
Okay. So right away, we're thinking insurance products here because this is the only time you see separate accounts and general accounts. The variable products are the ones that have the separate accounts.
Yeah.
The fixed one, like fixed annuities and regular life insurance, is the thing that has a general account, which I don't think you need to know a ton about for an exam. This is not an area that you need to be really too worried about, but
What got me was the reason why I didn't answer it was because of this.
may include both types of accounts. Wow, they're going in the weeds in this one here.
And they're talking about fixed accounts, aren't for that essentially, aren't they? The fixed rate account
yeah. I mean,
that you can get that are inside of annuities. One of the sub account options is there's always a stable value or
yes.
or something.
Exactly. So it's almost like you have a hybrid between the two. It's possible. I mean, you're always going to have a variable aspect in a separate account, a variable annuity, but you can have part of it in a general account. I would not be too concerned about that question. So, yeah. Separate account, by the way, looking at D, maybe just one thing real quick. Separate accounts can hold bond. They can separate accounts can hold really any type of security. There's no limit. Most of them do. A lot of them do hold equities. I mean, D is definitely a good generality. General accounts are very safe. Those are the accounts that the insurance companies run. Just usually talking about very safe bonds in there, but they're not limited to just bonds. And I'd say the same thing with separate accounts. Separate accounts are usually equity focused, but they're not always just equity. Yeah.
Mm-hmm.
Regard to recruitment advertising by member firms, which the following statements is true. Yeah, they can talk about recruitment. They're talking about getting employees in the door, new employees typically. So yeah, you can do it. It just can't be. I don't think there's any crazy rules you need to remember about it. But this is not you engaging the public trying to get them to invest. This is you trying to find new employees, and as long as you don't exaggerate, just like normal, you're fine. Yeah. So selling dividends. When you saw them mention this, did you know what they were referring to?
No.
Okay, so selling a dividend means that, like, if you were my customer, and let's say a stock is about to pay a dividend or a mutual fund is about to pay a dividend, if I were to say, hey, Scott, I really think you should get into this as soon as you possibly can. The X date is tomorrow. You need to buy the stock like today, because if you get it today, then you'll if you buy the stock today, you'll get the dividend that's payable here in a couple weeks, which on the surface sounds great, right? It sounds like a good thing to buy in and start getting paid immediately. But here's the thing: like if let's say the stock price, I'm going to put this on the screen. Let's say the stock price is 50 at the time. And let's say the dividend, they pay a dividend equal to, just to make it easy numbers here, let's say $5.
Mm-hmm.
So I'm like, hey Scott, stock price right now is $50 per share. If you buy it today, you'll buy in, you'll get the shares, and you're going to get a dividend paid to you in a couple of weeks. It's worth $5 a share. How good does it sound to buy something and get paid immediately? Sounds great, right? To the untrained eye, that sounds awesome. But here's the problem with this, is that when customer buys a stock that's about to pay a dividend, on the ex-dividend day, that stock price is going to drop by the amount of the dividend. I don't know if you realize that or not, but on the ex-dividend day, that stock is literally going to drop down to $45 a share. So if I convince you to buy the stock, the next day, if the next day is the ex-dividend day, the stock is going to drop by the same exact amount of the dividend. So it's almost like, it's a wash there, right? Like stock price went down by the amount of the dividend. Yeah, you get paid the dividend, but at the end of the day, like it didn't matter to you. You have stock that's worth $5 less, and you have $5 more cash in your hand. It really doesn't make a big deal, right? But here's the second layer is why the regulators really hate people doing this. It's because that dividend's taxable. So actually, if you recommend to someone to buy into a stock for a dividend that's about to be paid, just to get that one dividend, it's actually, you're doing your customer harm, because not only is it a wash just by the fact that stock price is going to drop by the amount of the dividend, but also on top of that, the customer's going to pay taxes on that dividend. So it's a net negative effect on the customer if you do this. I haven't even looked at the answers yet, but before I move on from that, I want to make sure that makes sense. Do you get what I'm saying there? You got that? Okay. So the amount of such distribution is included in the price paid for the shares. I mean, I don't know. This is what I said in a different way. I mean, just they don't want you doing it because it's a net negative effect, and that's what selling dividends is. That's what they mean.
Okay.
Let me clear that up. Subscription agreement does not specify. When you saw this, did you know what they were talking about with a subscription agreement?
They were talking about DPPs.
Yeah, DPPs, right? I think the easiest way to think about a subscription agreement is it's like your application to invest.
Mm-hmm.
A lot of times you don't need to apply to invest in stuff. Like I don't need to apply to Google to invest in Google. I just buy Google stock. But with the DPP, because of the way it's structured and because of there's a lot of rules around DPPs, you have to apply to invest in one of these. That's where your subscription agreement comes from. The priority provisions upon liquidation, that would be in the partnership agreement, if anything. And normally that's just, I think you would know how that goes. It goes, you have your secured creditors, your general creditors. Maybe I know you mentioned creditors in one of the things you mentioned up front, but if a DPP liquidates, the order priority is you pay your secured creditors first, your general creditors second, your limited partners third, your general partners fourth. They're at the end of the line. Yeah, there you go. But yeah.
That's how
I don't think you need to know a ton about the subscription agreement, though. Just know it revolves around DPPs, and I really don't think you'll see a question like that. If a firm places a temporary hold on a customer's account, okay. God, that's kind of a weird, vague question there. Firms can place temporary holds on customers' accounts, and that usually there's a legitimate reason why. Like the most common example I saw in the real world when I worked for Fidelity was like maybe we had like an elder abuse situation that we thought was going on.
Yeah, that's what I think of when I think of hold. Is I think of elder abuse. Somebody's taking advantage of somebody that's older.
Yeah, exactly.
That's why I was thinking it applies to distributions.
It can. I mean that sometimes C is not a bad answer. It just it can't. You can apply it to the entire account too. I've seen it both ways, where we just shut down an account in its entirety, or if we felt like a specific person that was attached to the account was not acting in the best interest of the customer, we would prevent them from doing specific types of disbursements. So you can do either one. It's just it's up to you. It's up to you as a firm. You're in the driver's seat. That company, I should say, but. Firm that is planning an offering of common stock is not yet filed a registration statement, which following actions a part of a register representative are not a violation.
It makes sense.
Yeah, looking at that makes sense. You can't do a thing. Contact investment banker. Yeah, you can't do anything with customers. You can't even mention this before they file the registration statement. But while we're on this topic here, do you remember that if let's say they file the registration statement, which kicks them into the cooling off period, there's some things that we can and can't do. What
I can like send you a prospectus, but I can't like attach a note to it that says, "Hey, I think you should buy this."
Good.
I can send you the statutory prospectus.
Good.
I can call and tell you about it, but I can't make a recommendation to buy.
Good.
Like I can talk to you about it, but I can't.
Yeah.
Tell you. Pretty much what I think of. I just can't tell you to buy it.
No, you're right. You can't recommend. You can't solicit. You can't take money for it. You can't promise a sale. What can you do? You can give out the preliminary prospectus, the red herring. You can also do it. The tombstone's more of like a issuer / underwriter thing that they'll do. And the last thing is, I think you mentioned that you were alluding to this, but indications of interest. You can take indications of interest. So good. Determination of.
Indications of interest?
I'm sorry.
I thought you could take indications
You
of interest.
can. You can. Sorry. You can. You can take indication of interest. They're always non-binding. Either they're non-binding on the customer and the broker dealer or the firm.
I just take down your name, and I know I can call you and probably
Exactly.
make
Exactly. Yep.
All right. So this,
Determination.
I
Yeah.
thought the SEC.
Yeah. What a weird question. I don't think I've ever seen them ask this of when the NAV is calculated. It's almost always at the end of the day. But yeah, technically the prospectus would have that information in there. So I really don't think you'll ever see anything on this, but some firms or some mutual funds used to have like multi-day, like Fidelity used to do this where they would calculate an NAV in the middle of the day and at the end of the day. Nowadays, almost every mutual fund just does it at the end of the day, but technically they'll describe that in the prospectus always. So yeah.
The next one, it's the it's the long-term prices fluctuate more.
Yeah, good. Yeah,
And
long and low with prices.
It's the rates fluctuate more with the short terms.
Good.
Versus,
That
I
one's
went
tricky.
back and read through the bonds.
Yeah, no, you got it. XYZ earned $4 per share, paid out $2 in dividends. XYZ is selling at 56. The price to earnings ratio. I mean, looking at this one now, does that make sense?
I took into account the dividends.
Yeah.
I thought I would subtract out the dividend from.
Yeah.
But now it makes sense.
Yeah, the only time the dividend would come, they might mention like the dividend payout ratio, which the dividend payout ratio for this one would be 50%.
Okay.
Does that make sense? Like they earned $4 and they paid out $2, so they're paying out 50% of every dollar they earn. Mm-hmm. But yeah, the price to earnings ratio is all about the entire earnings a company makes. Every company is going to have a PE ratio, whether or not they pay a dividend, because we're just looking at how much a company earns. Now, how much they pay out to customers, that's a different story. But yeah.
So I get where I went.
Okay, bond is 6%.
This one was just I don't know why yesterday I was having issues with this.
Okay.
But
just
I would discount because I'm looking now. I think of the seesaw because basis is yield to maturity.
There you go. I was going to say. Basis is yield to maturity.
Is your nominal rate. That's going to be in the middle.
Perfect.
So you're going to it's going to be at a discount. The price will be at a discount. And
you got it.
If you flip those numbers, it'd be a premium.
You got it. Cool.
Oh, yeah. I get where I went.
Individual received $500 in dividends from common shares that she owns of an oil company. How much of this dividend income is subject to taxation?
All. They threw in the oil, so I was thinking, oil and gas, maybe it's going to be tax free.
Yeah,
no. The only thing that oil and gas is depletion, right?
Yeah, I mean, you got the depletion stuff on there, but here's the other thing. Like this, I think they throw that in there to make you. I think, a lot of people will fall into that trap of thinking, okay, this is DPP related stuff, but no, this could be as easy as like you invest in ExxonMobil stock, which would not be a DPP, right? Like that's just you owning stock. It's just all of it's taxable to you, right? I hate these inventory evaluation methods. Which shows a greater profit in a period of rising costs. Like looking at it now, like if we're talking about rising costs, and they're asking us which one of these would give us the highest profit.
First out is because you made it when the costs were lower.
Yeah, you're selling the things that cost the least.
Yeah.
There you go. That's a tough one. Which represents any electronic communication that has been prepared by a firm with 75 existing. So this falls into the retail communications bucket. Anything more than 25 falls into that, which requires pre-approval by the principal and has to be filed with FINRA typically. Communication explains to customers that account statements aren't available online, which two of the following statements are true. It is retail communication because it's more than 25. You got that right. And then the activity should be, oh, hey, the no pre-approval. This requires principal proprietor use. What's their explanation? Is it just because it didn't go over like a product? The communication is if the retail communication does not make a financial recommendation or does not promote a product or service to the firm prior principal approvals, so they're going further down the rabbit hole than I've ever seen the 7 go on this one. Usually I think it's just safe to think that retail communication is pre-approval from the principal and has to be filed with FINRA. But they're right. This is like probably like a easier Series 24 question, if that makes any sense. This is the stuff the Series 24 will test you on. And yeah, they're right if they're being very specific here, but yeah, you don't need pre-approval if it's not something that you're not promoting or if it's not a recommendation or something along the lines of like a product. This one's tough, but I think
why I selected.
I see why. Yeah. If I wasn't like if I was going through that one quickly, I would have answered exactly what you answered and got it wrong. So yeah. But the generality, like if they gave you that question and they didn't tell you exactly what the communication was saying, then you generally speaking want to think pre-approval and file with FINRA if it's more than 25.
Mm-hmm.
Okay. Customer would like to open an account designated by a number. These are called numbered accounts, and
People.
Yeah, I mean, have you ever seen these? This is very rarely talked about, but it could show up.
I've seen it in the book. I saw it in the SIE and the Series 7 book.
Yeah, I mean, you can do it. Just the big thing they want you to know is that there's got to be some kind of record in the background linking the actual customer's identity to that number. A lot of times, celebrities and people who are like well known open these types of accounts just to keep their identities somewhat hidden. So yeah.
Yeah, that's what I figured.
Yeah.
I knew you could open it. And I just that I see it. Okay, just one step further.
One step further. Conservative investor has a long-term time horizon. He wants an investment that will provide him with long-term capital appreciation, will not be too volatile. Which of the following funds will be most suitable for him? So long-term capital appreciation. So we want to buy low, sell high, and not be too volatile. Okay.
The reason why I thought fund of funds is because I was thinking, well, that could be, it could have a bunch of conservative funds in it.
It's not a bad answer for sure.
I guess the value fund, but you're looking for underappreciated stock that you're hoping to appreciate with. But when I think of value investing, you're looking for stuff that nobody else is paying attention to try and find a diamond in the rough.
Yeah, I agree with that. I mean, these suitability questions like this are always a process of elimination. I mean, looking at D would be the first one I get rid of, right?
I knew B and D. There's no way.
Yeah, those are a little bit more on you're taking a little bit of volatility. I with C, the only thing I would argue against with C, I mean, funds of funds are not bad investments, but they do come with 2 layers of fees, and I wonder if that's what they're going to talk about. Did they even mention it anywhere?
Both fund and emerging markets would be too risky.
What is he talking? What are they talking about there?
I wonder if they think those are the hedge funds.
Maybe
fund of hedge funds. That's the only thing I could think of when I read the explanation because I cussed out the screen. I had to make sure that wasn't very loud.
That's a bad answer there, man. Fund of funds. I don't know how many of you've seen. I've seen some of the most conservative funds I've ever come across are funds of funds, man. It just a fund of funds is very general. It doesn't really tell you much. I don't think that's a bad.
I was thinking like a target date fund.
Yeah, like the target date funds. Yeah, right? Yeah, like if you have a 2020 fund, it's gonna be very conservative, right? So yeah, you're right. You're right. Investor wants to hedge a portfolio on preferred stocks can buy. Oh God. Okay. I like your answer because that's going to be the answer almost always if you're trying to hedge a portfolio of stocks. But the problem is we're trying to hedge preferred stock, and they're talking about these yield-based options, which are literally interest rate options.
Mm-hmm.
So here's the deal with that.
In the opposite directions.
It goes opposite, right? Like you're betting on interest rates either going up or down. So like, where do preferred stocks get hit when interest rates go up, right? Interest rates up, preferred stock prices down. So we want to buy an interest rate option is going to make money if the interest rates go up, and that's a
Yeah.
call. So that one's very tough. You got a currency based option and an interest rate option in the same test. I would tell you you're probably not going to see more than one of either one of those, meaning like combined. I would. This is kind of a crazy test. So yeah, I believe you on the SDC thing, adding some points to this. Analyzing mutual funds.
73, so it makes me feel a little bit better.
Yeah. I think you're in a really good spot between now and next Wednesday. You're in a great spot. When analyzing mutual funds expenses, an analyst does not consider. Okay, analyst looking at the fund to figure out if it's a good fund, is it efficient, blah blah blah. Okay, what do they not consider? Yeah, I see what they're saying there. Management fees definitely, funds expense ratio definitely. I mean, you answered the fees charge. You probably begrudgingly answered B as like I just don't know what else to put there. But
yeah,
the sales charge does factor into like a customer's efficiency, like how much money they can make off the fund. But here, like if we go into the weeds a little bit on this one to understand this, like when I'll just think about this from like the lens of like Fidelity funds, right? Fidelity, like if you came to Fidelity and opened up an account with Fidelity and you bought a Fidelity fund, you would pay no sales charge. And also, we also had like a network of other companies that would sell our funds that we would have an agreement with them where those companies would not charge sales charges. So, but if like a Vanguard or like a Charles Schwab sold a fund, there'd absolutely be a sales charge on there because we wouldn't have any kind of deal with our biggest competitors. So maybe that's a way of thinking about it there is just sales charges are very firm specific. And it doesn't really speak to how efficient the fund is. It's more talking about like how much the person that's selling you the fund is going to make off that transaction. And a lot of times the fund has nothing to do with that part of it, if that makes sense. Mm-hmm. So that's a tough one.
This one,
you got it? Okay.
No, this one's weird.
Oh.
To me.
So stating she received 2 statements, second of which she suspects was artificially created. Ooh. First statement shows a significant decline, while the second statement corrects the error to indicate appreciation of value. This complaint should be. Ooh, you're right on the first part. Reported to FINRA within 10 days. Yeah, if a customer alleges something significantly egregious, FINRA wants to know about it. This is another, I would call this also a Series 24 question. Normally, you just need to know what the customer complaint is. It's only legitimate if it's written, and when it's written, the principal has to overlook it, and you have to have some kind of like notation system of what you actually did to resolve the issue. But yeah, what do they say? If it's theft, misappropriation of funds, forgery, or events that would trigger those are all events that trigger requirement to report to FINRA. So FINRA wants to know about the crazy stuff. They don't want to know about much else though. So yeah. XYZ convertible debentures convertible into 20 shares XYZ. If the bonds were selling in the market at 960, would be the common stock need to be selling at parity. I mean, though I give you those parity price formulas, those might be good to know for the exam, but yeah, they're asking what the parity price of the stock is, which is the bonds market price divided by the conversion ratio, which in this case here, bonds trading at 960 and divided by the conversion ratio, which is 20, which parity price of the stock would give us 48. So that might be that. I don't know why that showed it all weird on your screen there, but basically, yeah. 960 divided by 20 is going to get you to the answer there. You always want to think with parity prices, we're trying to figure out, like, I'll give you an analogy. I think this analogy sometimes helps, but like that's like if you went to the store to buy like a 6-pack of beer, if you buy like a 6-pack of beer for $12, and I asked you like how much you paid for each beer, you'd say, oh, I paid $2 for each beer. Well, kind of the same idea here. Like if you went to the market and bought a 20-pack of stock for 960, we're really just asking ourselves how much what's the parity price of the stock? How much, if we buy the bond for 960 and convert it into 20 shares of stock, what are we actually paying per share of stock to do that? 48, if that makes sense. Okay. So, yeah, that's parity price. Those are parity price. The 2 parity price formulas might be something you might want to
memorize.
Try to memorize, because those questions are pretty much guaranteed to see. This question is how many are you going to see? So, cool.
Yeah, they give you lots of final exams.
Awesome, good. So,
here's which one?
Second one. Okay.
The second one that I took on the day.
Okay, it took a little bit longer, but I mean, it's all good. I mean, bottom line is you're still finishing it well within time, so good. Municipal securities principal must approve.
Everything.
Yeah. Yeah. Yep.
They
Everything they list there. Yep. Regulation T, which is only securities, is not
I
marginable.
didn't think mutual funds were.
Yeah, you got to hold them for 30 days. Now you can't buy mutual funds on margin, but when they say it's marginable, that just means that they add to your collateral in a margin account, but only after you've held them for at least 30 days. It's
So
the same rule with IPOs as well. Like you can't buy an IPO on margin, but after you've held them, if you buy like an IPO and you've held it for 30 days, then it adds to your collateral in your margin account.
okay.
Um,
The OTCBB, those are the ones that are registered, right?
mhm.
OTC pink market. That's the one where it's companies that aren't registered, right?
Well, maybe they're all. I'd say they're all registered. I mean, for a security to trade publicly, they're all. You have to be registered with the SEC. Maybe what you're thinking is the word listed, possibly.
Listed. Okay.
Yeah. Now I would tell you OTCBB would be not unlisted as well. Like listed to me is I'm on the New York Stock Exchange. I'm listed on the New York Stock Exchange, Nasdaq, American Stock Exchange. Usually, you're looking for either the word exchange or Nasdaq.
These
If
are
it's
where treasuries and stuff trade, correct?
The OTC market is
Yeah.
where treasuries trade, but the OTC BB is like a trading. It's like a trading system for like penny stocks.
Penny stocks. Okay.
Um,
This OTC is where over. Okay. Okay.
yeah, yeah. I don't think you need to know this, but like you might be wondering like what's the difference between the pink sheets and OTC BB, and they're pretty much the same thing. OTC BB is where unlisted stocks trade, but it's unlisted stocks that are current in their SEC filings. if
Okay.
if you have a stock, sometimes these penny stocks fall behind in their SEC filings for whatever reason, and if they do, then they have to trade it on the pink sheets, as we call them, or the pink OTC market, whatever you want to call them. But I think in general, if you just think, okay, that's where the penny stocks trade, and these are where companies that can't be listed on exchanges, this is where they trade.
Mhm.
Okay.
This one, I was thinking because of the bond trustee, he's the one that oversees the covenants.
Mm-hmm.
So I was thinking he was be the guy to have to approve it, but I get it. The state legislator,
Yeah.
it's going to be the state is going to be the one that's going to foot the bill.
Yeah, you're right. I mean, the key word there is the moral obligation. You just have to remember a moral obligation bond has to deal with the state legislature. Yeah, yeah. So good. So it's not true regarding the purchaser of a put option. So buying a put, have the obligation to buy stock. Okay. Sorry. A purchaser of a put, the right to sell stock. Sorry, right to sell stock. Purchaser limits the amount of money he could lose if the value of the underlying stock increases. You see that with B. After looking at this, does it make sense in terms of what the answer is?
Because well, you have the right to sell the stock.
You do.
The purchaser, you benefit if it goes down.
Mm-hmm.
And you do because you
Well, sorry, I was sorry. I just had a light bulb moment to myself, which doesn't matter. So keep going. Sorry.
the purchaser limits the amount of money he could lose if the value of underlying stock. That's true because you can
Mhm.
sell. So
But also, I'd say when like purchaser limits the amount of money you could lose. I mean, the bottom line is that when you buy a put, you have limited loss potential. I mean, just like you don't. Whenever they say something like B, that just means they don't have unlimited risk. Is what they're saying there. Um, but yeah, with D, like yeah, I mean, exercising the option, that's one way to make a profit. But you could also do a closing transaction. You can do a closing sale and sell to someone else at a profit. You could.
yeah, the right to sell. Da, 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 da. This is the one that I forgot about. The sell is going to turn into. It's going to add to the SMA. It's going to
Mm-hmm.
add 500 to the SMA, which is going to allow us to borrow $1,500 in cash.
Exactly. I don't know if you also noticed this too, but this is a restricted account.
Yeah.
Right? They mentioned in the answer there, you're below 50% equity. So yeah, that's the case. That's just weird rule there. Yep. He's concerned by that his boss is making inappropriate advances. Wow, that's crazy. Allegation.
I thought litigation.
So it's not the D is the best answer there. Like this is a good one to stop on because I'm hearing more and more people are seeing these types of questions. That maybe not the sexual harassment one, but if a registered representative has a problem with their firm, they're almost always going to be forced into arbitration. Like our arbitration is not only something that we do with our customers when they sign arbitration agreements, but it's also something that you are forced into as a registered representative. And when you sign the U4, you basically are agreeing that you're going to go through arbitration. But the one exception to that is sexual harassment. Sexual harassment, you if you wanted to, you can sue your broker dealer, which obviously makes sense, right? FINRA doesn't want to. I mean, technically, FINRA could handle that through arbitration, but FINRA, generally speaking, doesn't want to handle this type of stuff. They would prefer the court system too. That's the idea. So, yeah.
See, I just thought I'd think in court system. That's why I picked.
Yeah. It sounds, and I agree. I like your answer. I like your answer. It's just that technically it's
I
the
guess
choice.
this one it makes sense. Anything that they want to do, they can do it.
Exactly. Which last name is true for spreads? Okay. A put spread created for a net debit. Okay. So here, I get how these questions can seem like they're really tough on the surface. I mean, how about let me ask you this. I mean, after looking at this, did you feel like you completely got it, or you want me to walk you what my thought process
I
is?
want to walk through this one.
Okay,
This one,
cool.
I about punch the screen.
Cool. So looking at this one here, a spread, like when you're asking yourself, like, what do I like? Sometimes you get a question about like, what is the market sentiment of a debit put spread, right? When you look at this, and what's the market sentiment of a debit put spread? Which is what they're. I don't know if that's what you picked up with A, but they put spread created for a net debit. This is a debit put spread. Okay. If they ask you what's the market sentiment or what the customer wants to have happen, I tell everyone just cover up the word spread, right? If I were to ask you like, okay, if we just cover up the word spread, okay, I see, okay, debit put, and just let me cross out the spread real quick. But if we think a debit put, what comes to mind when you think of a debit put?
Buy a put.
Buy a put. What's buying a put is what? Bullish or bearish?
Buying a put is bearish.
Good. So I mean that's the way I would approach these questions, and that will always work. So like if we look at like B, for instance, they're talking about this. I read that as a credit put spread, right? Credit put spread. And if we're going through my philosophy there, right, like cover up the word spread, pretend the word spread isn't there. What comes to mind when you think credit put?
Credit means you took in. That's where you're going to buy. No. Credit is you're selling.
You got it. Selling a put, right?
Taking it in. I'm thinking of the T-chart.
Yep.
Taking it in.
Yep. You're taking it in. Good. So good. Selling a put, and selling a put is what? Bullish or bearish?
Selling a put is bullish.
Good. That's why B is not the right answer, right? Let's go through C. So I read C as a credit call spread. Okay, so what comes to mind when you see credit call spread?
All right, so we sell call.
Mm-hmm. Selling a call is bullish or bearish?
Bearish.
There you go. That's why C is not the right answer. And then last one, just to finish our exercise here, this is a debit call spread, which if we want to think about what the market sentiment is here, I'd again encourage you just cover up the word spread, pretend the word spread's not there, and let's just think through what that tells us.
We're going to buy a call, which is bullish.
Good. That's why D is not. Does that make sense?
That makes a lot of sense. Now,
yeah, just cover whenever you get one of these questions about like what is the spread, like what does the spread want to do? Just think about if you can bring out the name and just cover up the word spread and just think, okay, does this mean buy? Does this relate back to buying or selling a call? And then think about, okay, what's the deal with that? What's the deal with that option? If it relates back to buying a call is bullish, therefore the entire spread is bullish. That's it. I think that's the easiest way to get there every time. Okay. Yeah. Mike is long a yield. God, you got another yield-based put option. I really don't think I could be wrong. Maybe you see one or two, but this should
Reverse.
not be a big part of your exam. But yeah, I mean, it sounds like you get it now. Like when you're playing the interest rate option or the yield-based option game, you're betting on where interest rates go. So yeah. Which following statement is true regarding tax treatment of municipal bonds? What a difficult question. If the bond was purchased at a original issue discount, the discount would be accreted based upon the constant yield method. Oh my, wow. It's almost like this better be a process of elimination question. If the bond was purchased at premium, it would be accreted. So maybe the first thing I'll put here, I can tell right away that A is the wrong answer because the word accretion or the word accreted means you're going to relate that back to a discount bond.
Yeah, because it's the
Right?
amortization.
Yeah, and then amortization is premium, right? So the way out the window, the premium will not be amortized if the bond was purchased at a premium. Oh, you can get rid of that. D, the discount will be amortized if the bond was purchased. Yeah, so that would be another thing I tell you. You know, discount is always accreted, not amortized. So you throw that one out the window too. But this one's a fair. I would tell you to just take my advice on this one. Just don't even worry about what they mean by the constant yield method. I've never even heard them mention that, and I've never heard of anyone ever telling me they've seen that on the exam. So don't, just going overboard in that one. Municipality borrowing for a short-term period to finance a capital project would issue. Yeah, commercial paper is not a bad answer. Municipalities can, but here's maybe the term you're looking for with the municipality. Commercial paper, you want to think, okay, corporations are typically issuing those, right? Corporations are the number one issuers of commercial paper. Municipalities can issue commercial paper, but they call it tax-free commercial paper. I think if they put tax-free commercial paper in there, they'll be very particular about that terms. But if they put that in there, I'd say that's probably as good as a good answer as D. But the bans, rans, tans, trans, all that stuff there in the municipal bond world. What is it? Short-term period to finance a capital project. I mean, a capital project is some big project they're about to build, probably with a big bond issuance. Does that make sense? Looking at that now, yeah. Capacity is reported by a member firm that has conducted a net basis transaction. Jeez, these are really tough. And a net basis I have to read the explanation. Net basis transaction: a dealer holding a customer order to buy acquires the stock on a principal basis and executes a customer order at a different price than the dealer's acquisition price. Since both the legs of the net basis net basis transactions? No. I mean, if you can remember, I have seen them from time to time mention it. If you can remember that relates back to principal trades, great. Now you answered riskless principal. You might see that somewhere. Do you know what that means? I mean, that is a legitimate thing you might see in the exam.
No.
A riskless principal, like before we even talk about like riskless principal, do you feel, how comfortable do you feel with just principal?
Oh, I'm comfortable.
Okay, cool. So a riskless principal transaction would be if a customer comes to you to buy, let's say you're my customer and you want to buy a stock, and maybe I look at my inventory and it's just not there. So if I go to the market, buy the stock in the market, and then sell it to you immediately out of my inventory after I've bought it and put it in my inventory for short-term purposes, that's a riskless principal transaction because I went to the market, bought it, put it in my inventory, sold it to you knowing that you were going to buy it from me. If that makes sense. So it's just a riskless principal transaction is when, market makers buying something into their inventory where they know on the other end, someone's waiting to buy that from them themselves.
Okay.
Okay. Fund bonds would increase the most in price if interest rates decline. Right? Long and low on that one.
Yep. Now I get it. It's
okay.
Prices long term.
Yeah, definitely prices long term, and then between discount and premium, that relates back to the low coupon. Like you always want to think long and low with price volatility. Discount bonds are the ones that you want to associate with. I mean, the deeper the discount, the more likely the bond is that it has a low coupon, like going all the way down to like a zero coupon. Bonds typically have premiums when they have higher coupons than average. So long and low all the time. If that makes sense.
For
for price volatility.
Long and low for price volatility.
Always for price.
It's short.
Yeah, for rates, it's short term for sure. Yeah.
Okay. Okay.
All right. All right. RMO. Wow. There's a lot of stuff here. Price. Wow. Convertible stock will be called at 60 per share. Preferred stock is convertible in half a share. Common is selling at 56 56 per share. Selling in the market at 110 per share. Jackson, those appears the price of the preferred stock will most likely trade in the market at. Yeah, I don't. They give you. This is one of these questions where they give you so much information that they're overloading you with, and you probably like in my mind, I like my if I didn't know. If I haven't seen a bunch of these questions just in the past, like I would think that okay, my mind's going like 15 different places. Like, do I look at the coupon? Do I look at the call price? Do I look at the convertible value? Like, what am I actually looking at here? Like, I'll tell you that everything they could completely cut out the second sentence. They could completely cut out the second and the third sentence, and it'd still be the same answer. When a bond is called or preferred stock is called, its market price almost always deviates or just goes directly to whatever the call price is. And whenever a call is announced, it usually means that thing is going to get called in like the next either couple weeks or maybe a couple months at the most. And no one's going to be willing to buy that stock for much more or much less than what it's going to get called at. This wouldn't make sense, right? Like I wouldn't buy it. Like if preferred stock's going to be called at $60 per share, I'm not going to buy it for 65 or really anything really above 60 because that's stupid. It's going to get called in a couple months. And also, like, there's no way that anyone's going to be willing to sell it at a much lower price than 60 because they can just wait and hold and wait for it to get called in a couple months at 60. So here's the big thing. If something is called, it's always going to deviate pretty close to its call price. That's usually where it's going to go, regardless of whatever else is happening.
Okay. Because I was doing the conversion ratio.
Yeah. Yeah. That's what I would that's what I would have done in your position. And that's their trap they want you to fall into. So yeah. Interest rates increase, which of following securities has the most price change? Right? So this is just another long and low question, right? If you can associate if you can associate discount bonds with low coupons and premium bonds with high coupons, that's what they want you to get across in this one. Long and low. Client owns a convertible bond. It's called at 104. The bond is convertible at 40 and is selling in the market at 107. Common stock is trading in the market at 41. Wow, they give us a lot. So, I mean, looking at this question here, I can do this pretty quickly, but I'll walk you through what my thought process is. Like, I think these questions are pretty common, at least in the convertible bond world. I don't think you're gonna see more than like 2 or 3 convertible bond questions on your exam, but if you're going to see this question, it's more like they want you to figure out like which of the following choices is least attractive. I go through every choice and just figure out how much money the customer gets in every choice, right? Like with A, the customer gets what if they allow it to get called? What is it, 104? So they get 1,040 if they go with A, right?
Mm-hmm.
If they sell the bond, I mean, the bond is selling in the market at 1,000. I mean, it's trading $30 above the call price, which is a little weird, but I mean, they put it in there. So 1,070. That's B is not going to be the answer. Convert the bond to common stock and sell the common stock. Well, let's think about how much money we get out of that. The bond is convertible at 40, and it's selling in the market at 107. Okay. So when they say the bond is convertible at 40, they're usually a little bit more explicit with this. Like normally I would see a dollar sign in front of that 40, but that's a conversion price that they just gave us. So do you know what you need to do with 40 to figure out what the conversion ratio is?
You divide it by par.
Right? It'd be 25, right? So 1,000 divided by 40 would be 25. 25, wait, am I doing that right? Yeah, 25. So 25 times what? The common stock is trading in the market at 41. So whatever that is, so it would be what? 825, I think. Am I doing my math correctly on that? 25 times 40 would be 800. So an extra 25 in there would be 825. Yeah. So if you did that, customer gets 825 if they do that, and then D is obviously not going to be the right answer, right? So does that make sense looking at that one now?
Uh-huh.
Yeah.
That's a
If,
good
if
one.
Yeah, just if you get these convertible bond questions, like which was the most attractive or least attractive, go through all the choices. Usually, at least one of the answers will be just something you can't do, and you'll have to recognize, okay, I can't do that. That's not an option. But let me clear that out. But ultimately, just figure out either the most or least attractive by how much money the customer is making in each option.
I don't even remember seeing
Oh,
the
dude.
those.
Oh man, that is tough. A company is considering listing its common stock on an exchange. Place the following venues in order from least to most stringent. Now, what I would tell you, I do think it's possible that you would get um, a question in this world that would involve stack ranking these three. Now, the global select is always the most stringent. I just remember it has the word select in there, and that just sounds prestigious, kind of, right? So global select is the most prestigious. If you can
See,
remember, that is the most and capital is the least. Sorry, go ahead.
I mean, that's why you can see how I did mine. I was thinking, well,
Oh,
okay,
yeah,
I
yeah.
was thinking select. Oh, that's got to be something important, but there's no
Good.
way it's more stringent than the New York Stock Exchange.
Yeah, you know what? To be honest, I would have when I looked at this question. If you asked me to answer it, I would have had a tough time getting the right answer here. I would have not known that the New York Stock Exchange has higher or lower, I guess, listing requirements than Global Select. But
What
hey,
are those exactly?
what like the different markets there, like
Yeah,
the
what are
Nasdaq markets? Nasdaq has three different tiers to its market, and this is something you're going to go deep into in the 24.
that's the
Uh,
one where you can see the prices, and then the other one is you can see all the different market makers.
You're
And
thinking level one, level two, level three, right?
yeah,
Yeah, a little bit different. I mean, you can find level one, level two, level three with any one of those three. It's just Nasdaq has different tiers for the market depending on like the sophistication of the stock that they're dealing with. And there's a lot more that goes into like a lot of times it revolves around like how like specifics of how fast the market moves, who's operating the market, what type of market makers are in there, et cetera, which you don't need to worry about any of that stuff for the exam. And for a question like this, if you know that I would tell you, know that global select is the most stringent and maybe capital market and NASDAQ is the least stringent, I don't think they're going to ask a question beyond that. This one's very tough. So, yeah.
STC.
Yeah, good times. I mean, looking at 61, you would have been right if it was an in-state resident. You can sell that immediately to an in-state resident, but
That's what I was thinking.
yeah, 6 months if it's out of state. That's it. Investor purchases a face amount certificate on a period. Wow, I got another thing that I've never seen. Like I think I've told you this before, maybe, but if we ever talked about investment companies, I usually just tell people just know a face amount certificate is a type of investment company, and that usually will get you the right answer. I don't think I've ever seen. This might be the first face amount certificate specific question I've ever seen, but the certificate is scheduled to mature in 10 years. After the fifth year, investor stops making payments, which the following is true. Wow.
You see,
Um,
people have. I've talked to people that aren't passing the SDC exams.
Yeah, I totally get it, man. I would tell you, know that a face amount certificate is a type of investment company. Maybe this will give you some context for what it is. I mean, back before mortgages were revolutionized, and like nowadays, like when people make their mortgage payments, it's your monthly payment is consistent of both interest and principal at the same time. But there used to be a day where that was not the case, where you would take out a loan from the bank and pay the bank interest only, and then effectively at the end of your loan, you'd have to pay them back all this principal at once. And the way that people did that is that they would basically put their money into these face amount certificates that would actually grow into these big amounts of money that they needed to make these principal payments later. So a face amount certificate is something that you pay into that eventually will grow into like a principal number that you're trying to get it to grow into. I don't think you need to know anything more than that, but I don't know. Don't even. What a crazy question there. Bond as a basis is 4.3, so I think yield to maturity. So we got a yield to maturity of 4.33 and a coupon rate of 5.7. If you're thinking seesaw there,
Yeah,
does that make sense now?
yeah. I think I hurried through it, and I was thinking that was this was the nominal because
Uh
that's
huh.
usually how they write it.
Mhm. There you go. You got it. Customer sells short 1,000 at 60. Departs this reg T. If October, okay. If the October the stock is trading at 75, a share which following is true. Okay, so it's selling short, so it went up. Account will be adjusted on October 23rd, and the maintenance call will be issued. If on October 23rd the stock is trading at $75 a share, which following statements is true, the account will be adjusted. What do they even mean by that? Short margin account is mark to market daily. Okay, they're talking about mark to market. When they say marked once a day, or when they ever mention mark to market, like what they're referring to is like, I think with these margin accounts, like you have to maintain certain levels of equity, like the 25%, the 30%. One
Mhm.
thing that, like, when they're talking about mark to market, they're basically saying is like when do they care about the numbers? Meaning that, like, my account could drop below, if I had a long account, my account could drop below 25%, like in the middle of the day, like it could go to 22 or 21 or 20%. But as long as by the end of the day it's above 25%, I'm in good standing. So that's what most firms will do, is they'll say, hey, during the trading day, we're not going to be concerned too much about what's going on, as long as by the end of the day you're above your requirements. And that's usually how it works. And that's really what they're getting at here, is like the adjusted, like they kind of take a look at what your margin, what your equity levels are at the end of the day. And then, yeah, I think if we ran through our equity formula here, which
But
I don't know.
I knew it needed to be called. I thought that they would calculate it at the end of the day, and then the next day they would do their adjustment.
Yeah. Yeah, I mean, I'll do this maybe just real quick with you, just to show. But like oh shoot, I'm gonna run out of room here. But I'll just have to, like, kind of jump real quick. The credit balance that we would start with, if it's $60 per share and it's 1,000 shares, that means that the credit balance would be 90,000.
Yeah.
Because you're selling short 60,
160.
yeah, right. And then your SMV would be 75,000. So our equity, because October 23rd goes up to 75,000, so we have $15,000 of equity. So oh God, I don't know why it didn't show the $15,000 of equity. And then whatever 15 divided by 75 is, which I assume if we're going to put it, what's 15 divided? It's less than 15 divided by 75 is 20%. So we're
Yeah, it was
below
low.
it. Yeah, we're below. So I don't know. That's a tough one there, but yeah. I mean,
I was
looking
on
at
the
it,
right track. I did the math. I remember doing the math and everything, and I just thought it would happen the next day.
yeah, that's it. That's it for sure. So cool. ABC Growth Fund has been in existence for 6 years. An advertisement that refers its ranking based on total return must refer to the total return for.
Yeah. Now
Yeah,
I'm thinking back to your Morning Stars.
just kind of a general rule there, right? I don't want to be too concerned about that, but yeah. Registered representative, one of his customers on the OFAC. That's not good. That means they're on the
Yeah.
SDN list, the specifically designated nationals list, which is essentially the no-fly list, basically. Who they got to notify? Wow, that's a tough question. Yeah, they do have to notify Treasury. That's who wants to know about it, essentially. So yeah, that's the
I
idea.
thought FINRA. I was thinking, oh, okay.
Yeah, yeah. All following misinformation must be disclosed on customers' confirmation. So we're talking trade confirmations. Okay. Yeah, I think this is probably what you're thinking about with your answer. The order ticket has to have whether it was solicited or unsolicited. And maybe this will help a little bit, but this is the way I kind of compartmentalize order ticket versus trade confirmation in my head. Order ticket is what the firm uses to keep track of what happened with the trade. It's all, you want to think of order ticket as internal, as we talked about earlier. So order ticket internal, trade confirmation external.
Okay.
So that trade confirmation is what goes to the client and what we send the client, and that's what tells them what happens with the trade. The customer, I know this might not make 100% sense, but the customer doesn't need to know whether or not the trade was solicited or unsolicited. They should know. And at the end of the day, do they really? I mean, unless it's a very forgetful customer, they should know whether or not they brought that trade to the broker dealer or whether or not the broker dealer brought that trade to them. Now, the broker dealer does need to keep track of their solicited and unsolicited trades, not only for regulatory purposes, but also for monitoring. firms should be monitoring their solicited trades a little bit more often than their unsolicited trades, just to make sure their firms are not going crazy. But they do have to disclose on every transaction whether or not it was an agent or a principal transaction. They do have to disclose commissions. They don't have to disclose markups. Don't have to disclose markups, but and then I think A just makes sense, right? Like that's definitely going to go on the trade confirmation.
Okay.
Okay.
So the solicited is where we talk to them, unsolicited is where we didn't talk to them.
Exactly. Well, I mean, yeah, I mean, just in terms, like the question is like, where did the who wanted to do the trade is really what you want to ask there. If the customer brought the trade to you and wanted to do, I mean, you might talk to the customer, but it's more or less like who decided to do the trade. Was it the customer all by themselves, or was it, did you give them guidance?
And then you'd have the not held orders where they give me the price and time to execute. They just say, I want you to buy X, Y. They give me the command, the security, and the amount.
Good. There you go. Which funding issues will most likely have a mandatory sinking fund? Ooh, what a crazy question. Okay. First thing I would ask is, do you know what a sinking fund is, or what that is?
That's to have the money. It's basically putting the money away for maturity.
Right. It's your, I think of it as like a piggy bank where issuers, usually in particular when they talk about a sinking fund, they usually talk about municipal issuers, but it's where a municipality would put money away to pay back their bondholders, right? So, not every term issue has a mandatory sinking fund, but if you think about it, like a term issue is where you have all bonds start at the same time and they all end at the same time. So term issues are always going to have the largest principal payment at the end of it, if that makes sense.
Yeah.
Right. So that's why, I mean, that's the answer there. I mean, you do want to associate the term sinking fund with municipal. In the world of municipal bonds, you're not going to see convertible issues. And then with serial and balloon, which a balloon issuance is a type of serial issuance. Do you know what they mean by a balloon issue?
No.
It's kind of like
Is it like a balloon payment with a mortgage?
Yeah, right. Like you have a big payment towards the end is basically kind of what they're getting across with the balloon payment. But yeah, if we think serial is where they all start at the same time and they end at different times, right?
Mm-hmm.
And a balloon version of that would just be same thing, all start at the same time and they end at different times, but we have a bunch of them, like a ton of them ending towards the end. Not all of them, but a bunch of them. So that's what a balloon issuance is.
Okay.
Municipal securities broker dealer has a control relationship. Let's just pause there. Control, that is something that you could very well see in the exam. Control relationship. Do you know what they mean by that?
Does that mean they work together?
Yes. A lot of times, yes. So like I'll give you an example. Like if you're if a principal at your firm also serves on like the city council, that would be a control relationship. Right, like where there's some aspect of your firm has some kind of control over the municipality in a way. Okay, that could be treasurer, that could be like, I don't know if it's like, your principal of your firm is also the mayor of the city, which that would probably never happen, but something like that. And before we even get to the answer, I see the second sentence there. When selling the bond subject to a control relationship, the big thing they want you to know is that you disclose. You gotta disclose control relationships to customers. Period. So yeah, I mean, looking at the answer here, 1, 2, and 4, you gotta disclose it to them prior to the trade in writing, and also for all types of accounts. And that's kind of the weird thing too. Like when you see discretionary, what comes to mind to you when you see discretionary account?
And the advisor has complete control of the account.
Exactly, right? Advisor just invests and they don't have to get in touch with their customers pretty much for anything. But this is an exception to that. They need to get in touch with their customers and even if I have discretionary authority, so let's say over your account, I would still need to call you and say, hey, I want to do this trade in your account. I think it's suitable for you. But by the way, our firm has a conflict of interest here. Just want to make sure like the principal, my boss works for the city. Okay. Something like that. Okay. And I'd say that's, you can keep going here, but that's more important than just with municipal related stuff. That also relates to corporate related things I think there's actually, don't tell Finra I told you this, but there's a question in their question bank from what I've been told that involves Bank of America and Merrill Lynch. Bank of America owns Merrill Lynch. So if a Merrill Lynch advisor wants to recommend Bank of America stock to their customers, they have to disclose that to them up front. Hey, by the way, the company I'm recommending to you, it owns my company. Does that make sense, what I'm saying there? Okay, cool.
Really? Bank of America owns Merrill Lynch.
Yeah, Bank of America owns Merrill Lynch. Yeah, it was back in 2009, believe it or not. Merrill Lynch was on the brink of bankruptcy, and the government brokered a deal with Bank of America, and they convinced Bank of America to buy Merrill Lynch. And the government gave basically partially funded the purchase, but yeah, Bank of America owns Merrill Lynch because of the Great Recession, almost 10 years ago.
I know this one now. It's just
assets minus they're restructuring it, right? Assets minus liabilities is equal to equity, so they're just kind of moving things around here. But yeah, that's it.
I just screwed up the algebra essentially.
Yeah.
I'm trying to reverse it.
Yeah, I get it. Yeah. Purchases ABC Corporation October 50 put and pays a premium of 7. Underlying security declines to 40. For tax purposes, the proceeds of the sale are okay. So I mean,
now I can do this one.
They look pretty good. I mean, looking at it now, I mean.
Okay, so I'm just gonna go through it. I'm gonna see if I can get the answer off the screen. So we bought a put 50 and we paid a premium. The stock price doesn't matter. Let's just throw it in there just to screw you.
Good.
So we paid $7. It's going to be 43 because you're going to subtract.
Solid. You got it, man.
Yeah. That was just me like, oh no, I don't know.
That's good. I'm glad we looked at that. That's something a lot of people are telling me they're seeing questions on the exam. So good. U.S. importer needs British pounds to pay for a shipment of goods, exchange of U.S. dollars. Yeah, I mean, you're probably looking at Philadelphia and thinking, okay, that's where currency options trade, which you're right. That's where is that what you're thinking or no?
Yep, that's exactly what I was thinking.
Yeah. If you need to buy or sell actual currency, you go to interbank, the interbank market. That's where currencies are traded. But yeah, the option market's Philadelphia. What's fine is an expense or charge not normally associated with a variable.
I was thinking redemptions fees, was thinking surrender charges. Now that redemptions is with mutual funds.
Yeah,
I was just thinking of the surrender charges.
Cool. High net worth individual, significant margin, employs numerous hedging strategies to hedge a risk on investments. Who will find the most beneficial use? Have you seen this? This is one I think is fair game on the exam. Have you seen them mention portfolio margin before? No. Okay, so there are a couple things you need to know about it. Normal margin rules apply to normal customers, but for people who are high net worth, sometimes they're very specific. You have to, in order to qualify for what they call portfolio margin, or portfolio-based margin, you have to start your account with at least $100,000 of equity, which gets a lot of people, cuts out a lot of people out of the game to throw 100,000 plus into a margin account. But if you have at least $100,000 of equity, you can apply for portfolio margin, which will basically allow you to get around the normal margin rules. So what they do instead of applying the normal 50%, 25% for long, 30% short numbers, what they do is they apply what they call portfolio specific margin requirements, which they're basically going to look at the actual risk that you're running into and then apply margin requirements from there, if that makes any sense. Okay. So like, I'll give you an example. Like, I think this will help a little bit. Like if we go long 100 shares at 50, and then we go long, you'll see it's on your screen 1 second, long 1 ABC Jan 50 put at like 4. So if you saw something like this, like if a customer wanted to do that in a margin account, the normal margin rules would say they have to pay 50% for the stock and then 100% for the option.
Mm-hmm.
Does that make sense?
Yeah.
Okay. In a portfolio based margin account, if you had a ton of equity and like you could have your firm essentially kind of treat you on like an actual risk basis, they would look at that and say, hey, your max loss, I don't know why the premium didn't show up there. They would look at that and say, okay, your max loss is $400, so we're just going to make you deposit $400 for this. So just wealthy people are the ones that are essentially eligible for this type of account. Again, the things you need to remember is that it's based upon the risk that you're encountering actually in your account, not the actual normal cookie cutter numbers. And you have to have at least $100,000 of equity to employ this type of to have this type of margin account. Yeah.
All right.
LRR has earned $1.10 per share in each of the last 4 quarters and has paid out 20% of his earnings in the form of a cash dividend. The stock is selling at $48 per share. What is its price to earnings ratio? So they give you, yeah. I mean, looking at this now, do you, like? I mean, I think.
I was taking
How does that make
the
sense?
dividend.
Yeah.
I subtracted the dividend.
Yeah.
I essentially took 20%. I
Yeah.
multiplied it and took 20% off of that, and then
That's why I think it's so important to see these questions. And that now you know you're going to go into the test knowing that they're trying to trick you the entire time. That's just another example. There's a lot of traps in that question, but you got it. So maximum underwriting compensation for selling a limited partnerships and public offerings. Shoot, I wouldn't have even known this number. If you asked me this, I would have had no idea it was 10%. But sure, 10%.
I guess.
Yeah, won't even worry about that one. Which fund positions would be considered a covered option? I mean, looking at this now, I mean, the covered. Remember, when they say covered option, they mean that the option, like first and foremost, they're only going to relate a covered option to you selling an option, right? So that's why you can throw B. It doesn't look like you're even looking at it, but you can throw B and D out the window because you don't need to worry about covering a long option because your risk is already limited, right? To the premium. But covered options are always going to be with short options, and you want to make sure that whatever it is that you have, the way that you cover it is by pairing it with something that covers your risk.
Mm-hmm.
A short put, the risk is when the market goes down, right? That's where you encounter risk because that's a bullish investment. Well, if you go short the stock, that if the market does go down, you're making money on the way down through the short stock position, so that offsets your risk. So bottom line, like we're not. That's why I think C is so tricky because C is an unlimited risk position, but that's not what they're asking. They're asking which of the following has a covered option. The short put's covered. It doesn't mean the position overall isn't risky. Does that make sense?
Mm-hmm.
That's a tough one for sure.
Because I was thinking that, that's a covered call
Mm-hmm.
at the top.
Oh yeah.
A,
Short.
right?
Short. If it was short the call, yeah.
Huh? Oh yeah, short a call. God. Ugh.
All good.
Long the stock, short the call.
There you go. Yep.
Yeah.
Yeah. Customer wishes to make a purchase based on his belief interest rates will decline over the next 15 years. Recommendation of 2, which among securities are not consistent. Okay, so
I didn't see not.
Oh, okay, you got it. Easy.
I was thinking.
You really got that question right then. So.
I was like,
Yeah. Customer purchases a municipal security in the secondary market at a discount. At the maturity, the customer will treat the discount. Okay, so this is such a random municipal tax question that you might possibly see on the exam. But if you buy a municipal bond in the secondary market at a discount, the IRS will fully tax that discount like it's interest income. It's just something that they will do. And by the way, like looking at like C real quick, that's something I do want to point out real quick. If you hold, this is bigger than most people give it credit for. The only time you're going to have a capital gain or capital loss on a bond is if you sell it prior to maturity. That's it. If you hold a bond to maturity, that discount, like if it's a discount bond, yeah, that's money in your pocket. It feels like a gain. Like I buy the bond at $900 and matures at $1,000. That feels like a gain. But if you buy a bond and hold it to maturity, that is considered taxable interest income, It's not considered a capital gain. The only time you'll see a capital gain or capital loss with a bond is if you sell it prior to maturity. If you hold on to maturity, the discount of the premium is factored into your. It's considered either a deductible ordinary income if it's a premium, or taxable ordinary income if it's a discount.
Okay.
Okay.
Alright.
Tough one.
Yeah.
Level debt service bond issue is one that's which combined annual interest and principal payments are equal. Yeah, I mean, you could see something like this. I mean, looking at the answer there, does that make sense? What they're saying there?
Yeah.
Yeah. So if they mention level debt service, like I don't know how much experience you have with like a mortgage, but I mean it's the same thing with a mortgage, right? Like what am I saying? Combined annual interest and principal. Okay, so no, it's not like a mortgage because those fluctuate over time. Yeah, they structure it in a way that you're paying the same amount of principal and same amount of interest every single year, so you're making it level. I don't think you need to know much more about that, but limited partner has contributed capital. I'm sorry.
This is that one that I was talking about earlier.
Yeah, limited partner is considered limited partner for both capital. Okay, limited partner is considered limited partner for capital contribution and a creditor for the loan. What a crazy question there. Yeah, it's contributed capital. 2 years later, extends a loan. Yeah, I mean, looking at it now, I mean, whatever you contribute to the limited partnership is considered a capital contribution. Whatever you loan to them, you're considered a creditor, or like the bank essentially for the limited partnership. I would not be concerned about this question though. I mean,
I was kind of thinking about that where they could call you for, more money.
yeah, I get it. So which following factors is least useful when analyzing the credit risk of an issuer of a revenue bond? The ratio of amount of a net overall debt to assessed valuation. Yeah, I mean, when you get a question like this, which I do think these questions are fair game, definitely. You definitely want to make sure you know what fits into the general obligation bucket and what fits into the revenue bucket, right? B is very much a general obligation thing. Like the term net overall debt is we're talking about like the debt of the municipality compared to the assessed valuation of all the homes in our municipality.
Mm-hmm.
So that's, I mean, they call that the debt to assessed valuation thing, and that's something you would care about with general obligation bonds, but not with revenue bonds. Everything else would be a revenue bond related thing, if that makes sense.
Yeah.
So okay. Penny stock rules apply to which of the following circumstances? A stock quoted on the OTC bulletin board. Yeah, that's where the penny stocks trade. And when they mention these penny stock rules, do you know what they're referring to?
Yeah, the under $5. I was thinking, I don't know why. I was thinking of the penny stock rule or
Yeah. Well, I mean, like, well, let me say just a couple things here, and you tell me if you remember reading this or know this. But when they mention penny stock rules, yeah, of course, a penny stock is any unlisted stock trading below $5 a share. That's a penny stock. But what they're referring to here is suitability requirements when it comes to you recommending a penny stock to a customer, which generally speaking should probably not happen too often. Or like, for like at Fidelity, we never recommended penny stocks to any customer, but I guess in the right circumstance it could make sense. And they're mentioning it down there, like if you basically you have to go through this big suitability determination with your customer, where you not only go through a bunch of questions with them to figure out what their suitability is, but also explain to them in detail why you're recommending penny stocks to them. But they don't apply under certain circumstances, and the circumstances they probably list under there are, number one, if you have an established customer, which is any customer that has been with your firm for more than a year, or if they've done 3 separate penny stocks trades on their own. Is that what they list? That should be one of the things they list underneath that. Yeah, the customer is defined as existing, so account with the broker-dealer for more than a year, have engaged in 3 or more penny stocks on their own. If the transaction is not recommended or unsolicited, yeah, if the customer just wants to do it on their own, you don't have to go through a big suitability determination with them. That's the other big one too. So that's what they're referring to, and you might see them mention something about that. I wouldn't worry about that last bullet point there though, but yeah. So rights of call and a put.
Now I see it's a short
You
strike.
see it? Same strike price, same expiration. If the strike prices or expirations were different, then you'd be right. Okay. Customer buys a July 50 call. Okay, cool.
I wanted to go over it
Cool.
today because
You saw it a couple times, yeah. XAM stock made the following purchases. Shares bought at different times. Mr. sells some XAM shares at 51 based upon the various purchases, which shares.
I figured it out what you would make at each one of them,
Yeah,
and
yeah.
I guess I picked the one that gave me. It was almost the one on January the 14th. They're close. I mean, the one on May 13th, and they're really close. They were like a couple dollars off
Mm-hmm.
of each other,
Yeah,
but it was the largest gain. So they wanted the greatest gain. I was thinking, well, can I get them a good gain?
yeah,
And it'll be a little bit less gain, but it's not going to be as much tax.
yeah,
It
yeah,
was. I should have just picked the largest gain.
yeah. There you go. Well, but
I,
also
I was looking for the one that was a long-term capital gain first off.
yeah,
To
they also
sell.
mentioned the lowest tax liability too, which is the problem on that question. So, so yeah, I mean that's why D is not the answer. So, yeah, cool.
So yeah, that's
A
what
lot of
the.
questions to go through. Yeah, I'm glad we went through all those. That's all. I mean, the questions that you're getting wrong tell me that like you're getting like the big picture in terms of the fundamentals. So that's good, man. That's good.
Uh,
Um,
how do I?
what else you want to touch base on?
How do I switch back to?
Oh, to stop sharing the screen?
Yeah.
Oh yeah, you can. I think at the God, I forget. Yeah, you're not sharing the screen anymore. So cool. Um, I know it's. I know we're getting close to 10 o'clock your time, but what else? What else do you want to try to cover tonight?
How do you think they'll give me the spreads?
The spreads. You want to go through this? You want to go through a few questions? Is there a specific type of spread
I
question you want
guess
to talk about?
I know. I'm just trying to figure out how much I want to really, because I like that one that method that you showed me there. Just take out the word spread and put the
Mhm.
debt before the put or the
Yeah,
call.
that's
And
it. I bet you that'll help more than you think it does. So just, yeah, I mean, if you're, I think STC let you create like just an options quiz or even a quiz just on spreads. Will they let you do that?
I can custom like options, but I can't just
Yeah.
pick like just
Okay.
spreads. It's kind
So
of
I
like
mean, yeah, that's what I'd recommend you do. I mean, just go like I would tell you if you're struggling with the math. I mean, maybe take a look at the video that I sent you last on the spreads related stuff. But yeah, when it comes to those, like what do you think is going to happen with the market, or what's the customer sentiment in the market? Just cover up the word spread, and it's going to tell you exactly what the customer wants to do. If you can relate that back to the single leg, like okay, I got a debit put spread. I mean, debit, I think long puts are bearish, so this thing has to be bearish. I think if you follow that thought process, that'll help more than you think. And obviously, I mean, if you really are struggling with spreads, I mean, I'll be available. I think I told you this. I have to figure out what my situation is tomorrow. I'm moving to a different part in Canada. I think I will have some connection. So if you want to talk again Thursday, Friday, Saturday, I think I should be around. But worst case scenario, I'll be back Sunday, and I'm wide open Sunday, Monday, Tuesday. So if you run into any kind of issues, we can talk about it. But yeah,
I'm definitely gonna want to meet one more time at least before.
sure. Yeah, and I mean, what I'd recommend that you do between now and when you sit for the exam, man, just like I know it's not going to be no different than what I told you last time. Just see as many of these questions as you possibly can, and yeah, I'll tell you right away, these STC questions you're seeing, these are crazy, man. So just, and that's good. I'm come from the school of, I think if your test questions are harder than the real test and more difficult, then you're going to be ready for anything. You're going to be ready for anything as it comes your way. So just keep up the good work, man. Keep doing what you're doing, and the questions you're getting wrong are telling me that you're getting the big picture when it comes to the fundamentals. So I think
Okay.
you're doing great, man. Yeah, you'll see that score start coming up.
Okay.
Okay.
Well, they're having me do more things at work now because we're behind.
I hear you.
They're having me do things that aren't principal related.
Yeah.
Going through we're getting overloaded with trusted contact persons.
Uh,
Getting deals with that.
I hear you. But at least, I mean, you'll have the weekend, right, to kind of bunker down and focus.
Yeah, I'm gonna take I know I'm gonna take a mental day probably Saturday or something.
Okay, cool.
I know I don't want to overload.
No, I don't think you should either. I mean, you're a hard worker. I mean, if you feel like you need to take a break, I think that's a good idea to kind of like, but to take some time off and let your brain reset for sure. But yeah, if you got Sunday and then I don't know what your schedule is next week, but if you have any time during the day to study, but I'm available at night. And also I think one thing that might help too is maybe if we go through a set of questions together. It doesn't have to be our entire session, but attack questions together and let me kind of like see how the way you're approaching questions and what you're focusing on to help you get better with that. So yeah.
I think that would help.
Okay.
That'd probably be what we probably want to do as like a cram thing.
Okay, cool. Awesome.
All right.
Are you feeling good for tonight though?
Yeah, I'm feeling pretty good.
Cool, man. Cool. Well, I think we went through a lot of good stuff today. I think you're going to feel great about the taxes and options. We reviewed all the questions that you went through, and hopefully that helps a little bit. Some of those are just crazy questions, but overall, just keep doing what you're doing, man. And you'll see eventually. There's two things that should happen if you just keep seeing the enough questions, which is see a little bit less vol. I mean, you're not really seeing a ton of volatility in your score, right? Like you went from like a 73 to a 68 or something like that. You're going to see that kind of get a little bit lower and lower, and then you're going to see your grade kind of start shooting upward. So keep the faith and keep doing it, and I think you're doing everything right. Okay?
Okay. All right. Awesome.
All right, Scott.
I'll email you and kind of I'll figure out.
Yeah, I'll wait to hear from you. No rush on anything. And if you have any one-off questions during the week, let's say something come across something you need me to answer for you, just let me know. Let me know if I can help out in any way.
So you said you'll be available Sunday, Monday, Tuesday.
For sure. I just don't know about Thursday through Saturday, but still, if you want to try to work with me Thursday through Saturday, just let me know, and I'll let you know. I'll know about what my situation is tomorrow afternoon. Okay. Cool.
All right. Awesome. Well, we went over a lot of different things by doing what we did tonight.
We did. So I think it was a really good session tonight, Scott. So awesome, man. Okay.
All right. Awesome. Well, I appreciate it.
It's a pleasure as always.
All right. Have a good one. Enjoy Canada.
You too. All right. Thanks so much, man. Take care.